welcome to Trade Live with IG. It is Wednesday, the 25th of June, and I am joined by Luke Moore.
It is indeed.
Fresh back from a stag do.
Fresh back from a trip. Yeah, I was in Palma over the weekend. Shout out to my best buddy, Will. We looked after him, let's just say that.
Did you do anything naughty to him, like, shaved eyebrows or...
No, I think I would have been absolutely killed if we did that. What we did,
he's on a roof on a mattress.
No, none of that. But he was quite against fancy dress.
Okay.
So we didn't give him fancy dress, but he used to be a goalkeeper, so he had to wear goalkeeper gloves all weekend.
All weekend?
All weekend. Can you imagine how annoying it is
in the heat?
Goalkeeper gloves all weekend in 35-degree heat. So we wound him up enough. It wasn't too bad, but we wound him up enough. We gave him a little bit of stick.
Good morning, everyone. Andrew McKilvey joining the fray, saying good morning. Halford's PBT ahead of expectations. Other companies making enhancing announcements today are SCL, PPR1 and ITM as well. Thank you so much for that. Jugger, good morning to you. Guten Morgen. I love a good goose in the morning. What does that mean? Good goose?
And Kate Murphy, look at you on time.
Oh, wow.
Excellent.
You're not on a naughty step today, Kate Murphy. She's been on a...
What is it? It's Wednesday. Everybody's getting in on time. This is perfect.
But given Kate, I believe, comes all the way from New Zealand, I'll let you off because it's really hard. I did date an Australian. I know it's not the same. I know there's this rivalry, extreme rivalry. But I'm talking about time difference, the time zone.
Oh, yeah.
Right?
You're
We're going to bed. They're waking up. We're waking up. They're going to bed, right? Tough one, Kate. Well done, you.
Yep. I did a stint in Malaysia for a little while, so it was kind of 7 or 8 hours.
Yeah.
It was enough. It was enough.
It was enough.
Yeah.
Enough.
Boise,
morning crew. Boise has been extremely good at guessing the stock recently. I've put in the post 3 in a row, so he's won 3 in a row, so all in one, so look out for it. Monkey Man, good morning. Wing It as well, and Funky Gibbon.
Everyone's in town. Everyone's in town.
Primate Zoo.
Everybody's in town. Should we take a look at what's coming up?
Yeah, let's take a look at what's coming up. Take us through it, Luke.
Have a little look. So it's going to be myself and Angeline through till just about 8:30. We're going to run through your opening bell, overnight action, and a bit of fast markets. Then we've got Axel coming in, the new piece of charting crypto. So that's going to be online from 8:35. Then you're going to be here at 9 a.m. Anyone joining you at 9 a.m. for the opening bell?
Clearly, the entire zoo. So that's great. The entire zoo. Brilliant.
Right. And then we've got a replay of Rich's interview with Michael Sain. And then me and Ronnie. But we'll get a bit of a replay there, Ponder replay.
Now, shout out to Luke and Ronnie. You need to watch this, Trader Friends, because it will change your life. It is so amazing. I've seen it. I've also sat with Luke, and if you want to see the picture of us, Luke accused me of breaking Lord. Yeah, it answered all his questions, but when I put in my multiple, very detailed, trading requirements, it kind of died for a bit.
It kind of rolled over a little bit, yeah. Our Claude's pretty robust.
Yeah.
But I think he struggled a little bit when he got Angelined. Witnessed the ong.
Just if you're not clear and detailed about what you want, then you don't tend to get what you want.
Yeah, correct.
Speaking of getting what you want, at the moment, that ceasefire and the relative, optimism in the markets seems to be holding.
It seems to be holding, but just before we get into markets, I want to just give a quick, very big congratulations to the England cricket team.
Yes!
Unbelievable yesterday.
I saw a headline, as crossing this morning. What happened?
Well, clearly we sponsor them. So that's part one.
Both the men's and women's.
The men and the women. We sponsor the right hand side because we figured out that there was more right-handed batsmen and bowlers, so that the brand would get all the show. But no, one of the biggest run chases ever on the final day. So it was, I think we chased down 371 runs.
Wow.
And I believe, if I'm not mistaken, it's only the second time that anybody has chased down a target after they've conceded 5 centuries. And the first time we've done it against India. So congratulations to the England men's team. It was fantastic to see. And that's 1-0 in a series. So let's see how we go for the rest of it.
Wow.
But what has happened overnight? let's talk about overnight action.
Let's talk about overnight action. Let's go to that right now. I love doing this bit because, you know, whatever news we cover in overnight action, we always keep it positive, don't we? We keep it positive.
Well, we are at the moment, of course. Congratulations to the Nasdaq. An all-time high yesterday, up 1.5%.
Yeah, and also the fact that, you know, across, you know, the volatility space, or implied volatility, still looking, you know, pretty calm out there, right?
Yeah, but it goes against, I think, talking to clients, a lot of people feel quite bearish.
Yeah.
But I tell you what was interesting. So obviously I was away from kind of all the action.
Yeah, you chose a good week, mate.
Yeah, I did. Well, good week or bad week, depending on which way you want to see it. I want to make sure that we're here to help clients. But I was probably expecting, you know, once the US strikes came in, for oil to be much higher, for the stock market to be much lower. But it was the market telling you that this was, you know, expected to be a one and done.
Yeah.
Okay? And then, you know, the retaliatory strikes were clearly non-trivial, I think, was probably the way to describe it. And the markets have shrugged it off. It's going to be really interesting to see how Trump talks today at NATO.
Yeah.
Because you're right. I mean, did you see the clip of him swearing yesterday before he jumped on his helicopter?
With the F-bomb.
Yeah.
Yeah.
I've never seen a sitting president swear on live TV.
Until now.
I'm kind of here for it, right? I'm kind of here for it. We're all honest, and he clearly believes that what he's done has impacted the Middle East positively. So I'm a realist, and I think if you're enthused about something, then yeah, you do what you can. But not great, because a lot of places can't now publish that comment.
Yes. I am a follow the markets kind of person. So I crunched some data, you know, looking at all the big news sources and the Bloombergs, the CNNs, the Reuters, and, you know, made a cool graphic, only possible after extensive training with the wonderful Luke. That's why you need to watch Talking Shop later on, because this has revolutionized my life. So the ceasefire, whacking up my chart here, I'm zooming in for you because there's a lot of information here. Ceasefire seems to be holding. Markets did rally, if you saw the last few days, and always follow the numbers. Follow the numbers, because that tells you what the markets are thinking. Both sides reportedly committing to a truce. You know, I've got the US position here, Israel's update as well. Israel, of course, claiming total victory, saying their campaign not over. Iran as well saying the same, well, declaring victory as well. And currently still very lacking in details as to what happens next. The big news, of course, is the fact that it looks like the targets are nuclear targets.
There's no, yeah. And that's the piece that I think is worth speaking about. If you can jump my screen.
Let's go to Luke's screen.
This is an article. So I was working on the US market shift yesterday, and we initially saw a headline come out of CNN saying that there has been a classified report that suggests that actually the targets that they were trying to hit, they were hit, but actually haven't done anywhere near as much damage as Trump has, you know, been led to believe. And so that then came out. It was also reported by the New York Times. And lo and behold, we wake up and at 6 o'clock in the morning, it's going around the kind of mainstream media, the FT reporting on it, so the Telegraph. And so they're saying that after an initial assessment, not as much damage was done as they had originally hoped.
Yeah.
And so they, depending on kind of who we're talking to, they believe that it's only going to have set them back by about a couple of months. It was obviously flat out denied. And Caroline Leavitt, so the White House press secretary, I think there's comments on here. She basically just said it was clearly leaked by a low-level loser who's got something against Trump, which of course, when you rule through fear and kind of tweets and everything that Trump does, you're going to get people like this that are trying to leak things. So it'll be interesting to see how that shakes out. You know, we know that we haven't had a huge amount of detail yet about exactly how these things were hit and what is left remaining. I think we're not going to get that immediately.
No.
This is the first first sign that perhaps things aren't quite as rosy as we expect. So we are risk on in the market, clearly. I mean, I'm looking across the IG platform and pretty much everything's blue this morning. It's actually not very often that every single market on our popular markets watch list is currently blue, apart from Tesla. But that is where we are today. So I'm watching for any more reports of breaches in the ceasefire. We saw that Israel had come out and said that there is not, this campaign has not been finished. So we're going to have to see on that one. I think if we're going to see anything shake that in the kind of real short term on a daily basis, it'll be breaks of that ceasefire. So that's going to be a risk. That's going to be a risk to keep an eye on today.
Yeah. And of course, that briefing as well. Interestingly enough, I'm going to show you oil here because it is up today after easing off, right? So it's up 1.3% there as we speak. Still, seeing that consolidation there. So this is the hourly chart here. I'm going to whack the daily there so I can show you what I mean by, it's still, it pales in comparison to the, easing that we've seen, which, really, Matt Alba and I were sat here talking about this the last 2 days, really tells you a lot about, the mood of the markets at the moment. Gold also was, eased off yesterday. Let's take a look at gold today.
Seems to be stabilizing.
Yeah.
I mean, it was heavily sold yesterday and we seem to have found a level.
Yeah. So it's all this to us anyway for now, showing that ceasefire optimism still, hanging in there, holding.
Yeah, I mean, I think I was chatting to a few people yesterday, and from at least my memory of being in this business for 11 years, conflict like this is short-lived and quickly faded.
Yes, as long as it's contained, right?
Correct. Yeah, and so the strategy of fading these conflicts seems to be paying off. So that's going to be something to consider. We'll just keep an eye on everything that reacts. But yeah, you're getting lots of different comments that come out. So yes, gold has come down and bounced a little bit. It's found its level. Yes, oil's come down and found a level.
Yeah, and also markets,
Yeah, but you've got everybody arguing with each other. So Trump is saying one thing, Iran is saying one thing. They said they're going to continue their nuclear program. I think if there is a possibility that it brings Iran back to the table, that's positive. Looking for a diplomatic solution.
Yeah.
If the ceasefire holds. So yeah, we're going to have to see. We're going to have to see how it goes. Let's move on.
Yeah. Can we just get Jugger before we move on? Contrarian view. Ceasefire will not last until next Monday. Who will bet against me? Right. Let's
take a little look at. I want to take a little look at tech stocks.
Yeah, let's do that.
We have to. We have a all-time high on the Nasdaq. The S&P is only about 2% off, I think. And what I wanted to do is I wanted to just take a quick comparison between how the Mag 7 have actually performed, because you're starting to see some clear winners and some clear losers. And the reason why this is interesting, at least the reason why I find it interesting, was yesterday Apple. So Apple, Rich and I covered it a couple of weeks back.
It went down, didn't it?
Yeah, but Rich and I covered it a couple of weeks back. Their developer conference was disappointing. There was nothing substantial around AI, and clearly they're still very dependent on iPhone revenue. They've just been so weak. So we can use another example for how AI is revolutionizing tools for traders. So this is something I just jotted up this morning. So give me a stock performance of the Mag 7 from the start of the year, and I want a reference point starting at 0% from January 1st. And so what I hope is clear.
Right, so you rebased it.
I've rebased it from 0 at the start of the year. The winners up here, if I can get my mouse to work, are Microsoft. They are Microsoft, they are Google, and they are Nvidia. In fact, that's not Google. We've got Meta are at the top of the pops. And then I can scroll down here and it gives me all the data. And if you're looking here, the change since the 1st of January, Nvidia, Meta, Amazon, all absolutely flying, above 40%. Tesla up 87%, although a lot of that has been given back in the last couple of days. But Apple, 18.4%. Granted, it's a performer, but it is an underperformer. And I think that's really interesting. Yesterday, the market was strong, and I try to think that if you are looking at stocks potentially to fade, you want to fade the ones that are weak in a strong market. And yesterday, it was a strong market, and Apple's very weak.
Apple faded.
It faded into the close, and Tesla, after hours, broke the daily range and ended up in the post-market down about 3%. So if you're looking at ideas and you're looking at potential trade ideas today, I'd be probably looking at those two and maybe looking to see if you can get some setups there, especially as it looks like we're going to have another strong-ish start to the day with the S&P holding on to its gains overnight and the Nasdaq holding on to its gains overnight. So I would be certainly looking there. But yeah, the market clearly just not rewarding Apple for any lack of AI.
Yeah, and we talked about this earlier on too. Like, it almost seems as if they're a bit slow to AI game. And I remember having slight kittens because you were saying that you know, what's happening with Apple right now is that they're finessing stuff that they already have. They're retweaking, you know, all the cash cows, but they're not coming out with revolutionary game changers like in the time of Steve Jobs.
Well,
and
argue Tim Apple probably hasn't.
Yeah.
You know, the Apple Watch was before his time.
Yeah.
The goggles, I think, were a bit of a fad. There's been nothing necessarily that substantially new.
I think the last thing that was new were the
Vision Pro.
Yeah, and the
AirPods.
AirPods.
Yeah.
Which I hear, and I trust you guys because you go to our Twitter friends for a lot of sort of, you know, research and real time sort of views. I've been hearing that it's like, you know, exceptionally good. No one who's used AirPods that I know can go back. I just don't like things in my ear because I have to do this for a living. So I do have an IFB in my ear. So, you know, enough in-ear stuff. But yeah, Apple, I'm really concerned about because, you know, it's just not able to break through, you know, levels last seen in May. It seems to just be stuck. And each time we hit that level, we then come off again and just fail to break through.
Yeah.
You know, and looking, we always say here, like, is it Beyonce? To the left, always look left of the charts. Oh, I'm glad you like that. You know, it's really in the doldrums and just not able to catch a bit higher.
No, it's not. And if you want to just flick over onto my chart, guys, I think there was a really interesting piece that's been put together by Zero Hedge this morning. And so what you're seeing here is at the top, you've got a red and a green line. Now that red line is Goldman Sachs's specific AI basket of stocks. And then the green line is the company that have been defined as companies that are at risk to being disrupted. And what you're clearly seeing here now is a lot of divergence. You know, whilst we've been talking a lot about what AI means, you're now starting to see the winners win and the losers lose. And I think this is fascinating. And down here, you've got the ratio of beneficiaries versus those who are at risk. And you can just see kind of from basically tariff day, companies that are benefiting from AI have absolutely taken off. And so it's, yeah, if you want to take a look into those baskets, Google Goldman Sachs US AI beneficiaries and just take a look at those as a bit of a watch list for you.
Nice.
Cool.
Speaking of watching, have you ever used, go on.
I was going to say, we need to, 2 minutes before the auctions start, we need to start to have a think about the what's happened out in the UK today.
Yeah, cool. And also, lots of Andrew McKelvey has said he'd really like more upgrades and downgrades.
Okay.
So we'll try and get that to you as well. So yeah, let's start with the UK.
I've got some updates. Let's get the upgrades and downgrades out there. So Babcock have been raised to £13.70 from £12.80. In fact, let me just give you.
Let me bring up the chart because.
Yeah, let me just bring this up.
Here we are. Here's Babcock. Yep, this is the weekly. Let's get it down to the daily for you.
So they've been upgraded, JP Morgan, from £12.80 up to £13.70. Elsewhere, we've seen WPP has been cut to an underweight at Barclays. That's a price target now of £5.50. We've seen Johnson Matthey rated a new hold at Kepler Chevron with no target price given. Pension B, which I believe IPO'd last year, they've been rated as a new buy with a £2 price target at Peel Hunt. And then OSB have been tipped in the Daily Telegraph saying buy OSB.
Interesting.
So there's your upgrades and your downgrades. I did see a comment from, I think it was Andrew McKelvey about Filtronic saying, yep, some more good news.
I know,
so the
right?
last time I was on here, we were talking about the space industry.
Yeah.
And there is a really good, I haven't had a chance to read it yet, but there's a good long form opinion piece on the FT today about space. I will just see if I
Cool.
can
Ping it into the chat. Ping it into the
let me
chat.
just ping that into the
Filtronic's an interesting one too, because the other day after we spoke, I was looking for an ETF with Filtronic in, you know, because it's a good one. It's a good one to look at that chart. I mean, this is the weekly view, and let's look at the monthly, right? It's just shot off, just absolutely. And
Would you say it's taken off?
taken off?
Lifted into orbit?
Lift off for Filtronic, and even though it's you know, looking overbought, there just continues to march higher, right? Continues to march higher there. Some others, for
Just
those
to,
of you,
just to say what they've said. So they've basically given out their trading update and their full year financial highlights, saying that they've confirmed trading momentum has continued in the second half of this year, resulting in both revenue and adjusted EBITDA being marginally ahead of expectations. So let me just check to see if I've got any opening calls on these guys.
I'm on the chart here, and if you look at you know, the daily chart as well, it's all above the 20, 50 and 100-day moving averages. So very bullish momentum there. Whilst Luke's looking for some of the opening calls here, just a shout out to Stellantis as well. Stellantis, Jefferies, and whacking up the chart for you. Jefferies upgrade to buy from hold, saying that operations taking a more positive turn there. And also keep an eye on the likes of BASF as well, for those of you that trade the chemical space, because just putting that up there for you, European chemicals, at least for the second quarter earnings season, Jefferies says it's expected fairly similar with generally soft results there. So keep an eye on that.
Yep. We've also had out the FTSE 100 Babcock. They've announced their full year results, if you want to fire up Babcock just there. So we know they've been upgraded at JP Morgan, fantastic. But their full year revenue, they're actually being called unchanged by Singers. Their adjusted revenue comes pretty much bang in line with market expectations, £4.83 billion of revenue versus 4.84 expected. And they've announced a £200 million buyback. So good news for Babcock there. We'll see if the opening auction gives us any difference to the early calls. Elsewhere in the UK, Games Workshop, which is a surprisingly popular name that we see, and from memory, a surprisingly strong stock as well. If you have a little look at Games Workshop,
This is not one I've traded. Let's have a look.
and I'm fairly strong since definitely fairly strong since tariff day. So they've come out. They've declared an 85 pence dividend. And they're being called unchanged earlier. What else do we have here that's quite interesting? Halfords, yep, Andrew McKelvey, you've flagged that one. They're being called up 3%. Their full year revenues beat 1.72. Their gross margin beat, and they've seen their early trading bang in line with expectations. So that is positive for them. They're being called up 3.
Right. So
Filtronic also being called up 1%. Not a huge difference there.
yeah. So we have a heap of other things out later today as well. In terms of earnings, we've got, I believe, General Mills and Micron as well. Just having a quick look. How much time have we got, Yanis? Yanis is our new person at the wheel whilst Rich is on the beach somewhere, I think in Milan.
In Milan?
Yeah.
They had a show on Friday, eh?
They did. They did.
Everything happened during the show on Friday.
Yeah, and Rich was on air going, it was mental because, you know, it was just, there's so much movement.
Yeah, of course.
You know, everything was moving simultaneously, and you know, it's very directional. So they had to be really, you know, fast-fingered, changing legs repeatedly. I think Tom was like chomping at the bit as well at the back, so Rich had to like keep up, right?
Yeah, trying to.
And Tom was like, yeah, come on, change the limits, get in. So the Boise saying big up the Nottingham-based Games Workshop. Wow,
Big up Nottingham. That's where I went to university.
Nottingham University.
Nottingham University.
I hear it's a great university town as well.
Yeah, great town.
Great vibe. Let's get this up because tell me more, Boise. This is not one that I have traded at all. Like, you know, here we are. And correct me if I'm wrong, like you get Games Workshops in like all the Westfields and all those shops, right?
Yeah, well, they're a domestic producer of course, a highly I want to say their products are supported by their fans, very loyal fans. And so it's really interesting. I believe they were doing something in the way of films, potentially video games, so expanding into the digital space. And clearly, you know, the revenues that they're bringing in is continuing to work, and declaring a dividend, very good.
Cool.
Right.
Have we got some more upgrades and downgrades have come in? Have we got time? We got time, Newt?
No.
Oh,
Yes.
We got guess the chart. We got one quick one, just Interpublic. Try and look at that one. WPP also, Barclays cutting that to underweight from equal weight.
Exactly.
Right, let's go to guess the chart. Now, this is one that I have picked because Phil's not here. He's in in Malaga.
Okay. I was texting him yesterday to say how hot it's going to be. It was 35 degrees in Palma over the weekend. It's warm.
He's going to burn.
Warm.
He's going to burn. I did tell him bring a rash up. Right, are you guys ready? This is a US stock.
Okay, a US
On your
stock.
marks.
Get set.
Go! Hey, welcome back to the show. And guess who the winner is of Guess the Stock? You're going to give them a help? Lots of people got, you know.
We have a winner. We have a winner, Steve Davis.
Congratulations. Well, there you go. You know, we were talking about this earlier. You were surprised by how cheap this.
Yeah, I was expecting it to be a higher priced share. $25 to me seems like a low price, but they obviously had their results yesterday.
They did, and Shockorama, big demand for cruises.
Yeah.
Meant that, look at the share price reaction. If you want to look up on the chart, that big move higher there.
Have a little look for that, and I need to find
get
a way
ready
to
with the bell.
ring the bell.
Carnival this morning as well, seeing JP Morgan raising its price target to 34 from 31 bucks. How far away from the open?
10 seconds till the bell. Right, I haven't got anything to ring the bell, so I'm gonna have to use my silly phone stylus.
Yes.
Let's get it here.
Creative. Go! Woohoo! And we are off to the races.
Off to the races in Steve, you're welcome for the clue. That was exactly the clue that Angeline gave me whilst I was sat in this chair. So it wasn't
my
pure.
arm, Steve. You
It
twisted
wasn't.
my arm.
It wasn't a pure guess. Filtronic out the blocks up 3%, 2.5. 158 traded.
Let's take a look across the indices as well, looking like flat to higher. Germany 40 up 1/3% there. FTSE also just a touch higher there. Just taking a look at filtering this out to the gainers as well. Lots of movement there. Let's get it to shake out. Right, here we go. Luke, take us through the winners list.
Well, what I can't see on there is Babcock, and at the moment they are, if they're not open, hang on a sec, that might be why they're not open. They're indicating on my screen here is up 6. Babcock, are they out of auction? No, that's it. They're in an extended auction, which is why they're not on the screen just yet.
Nice.
Up 6.3%. So on results and on that upgrade from JP Morgan. Good for them. We look like we've got a bit of a miners' day. Endeavour, Fresnillo and Anglos up at the top of the pops there.
Yeah.
So potentially some of that dollar weakness coming through. I hadn't seen any stories specifically referencing miners, but they seem to be at the top of the pops just there in the UK. And if we look at the detractors, if you want to run through from
let's go to the losers list there, Pearson. Actually, it's all moving quite rapidly. There we are.
And WPP.
Yeah.
WPP on the back of that coverage.
You heard me coming out just as before we went to guess the stock. WPP did have a downgrade earlier on. Pearson also lower, and we've got Croda International also amongst the top 3 there. EasyJet, some of the airlines which bounced, last session or so, now starting to give back gains again. Of course, everyone eyeing the situation that very, very fragile ceasefire seems to be holding out in the Middle East. For how long, I don't know, but we have some contrarian views on our comments this morning as well. Whitbread down 0.5%. So some of the consumer names there lower. JD Sports as well is down.
Well, the JD Sports one is interesting because, of course, we've had some news this morning that we didn't get a chance to cover. A very popular retail name, the Hut Group, THG. So they've come out with some numbers. They are, where are THG?
Here we are. Ooh, up 7.8%.
Up 7.8%. So they're a company that's very heavily shorted. And Matt Mulder, as a CEO, has been very critical of how the London Stock Exchange is
Mulder?
I think it's Matt Moulding. Yeah, I believe that.
Moulding or Mulder?
Mulder. Hang on, let me just check that. He was one of the original leather jackets.
Before Jensen Huang.
Yes. Well, I think Jensen Huang's been doing it for, Matt Moulding. Moulding, and I seem to remember just seeing him with his leather jacket on. But look, it's just been from an IPO.
Look at that.
Yeah, it's been probably one of the worst IPOs that we've seen. I'd be interested to see whether Aston Martin is better or worse than that, just on an absolute percentage basis.
Yeah.
But scuttling along the bottom there, they've got. I think the problem that they have is that Matt has a controlling share, and so people don't like that unless that has changed. But from memory, I don't think it has. And he's just been applying more and more money into it, and it just cannot catch a break. But they've said their full-year guidance is unchanged. So a big reaction there, now looking like they're trading up nearly 9% on the back of that news. So well done to any long-term holders there.
Here's a drama on the 1-minute chart there for you.
Yeah.
Speaking of drama, you heard me talk about Stellantis earlier as well. Stellantis, take a look at that right now. It is up more than 2% after Jefferies ups the company's target to buy. So you heard that here first. Just checking out, I've built myself a nice little filter for the biggest movers across Europe as well. Some interesting names that I've not come across before. And Lumi Bird is one of them, up more than 4%. This is after the company's subsidiary Photonics unit secured a major naval contract. So you're seeing a lot of contracts being agreed and signed. Did you see Keir Starmer's comments yesterday? Those of you that have been watching the outcome of NATO, Starmer looking like he's trying to curry favor with Trump, right? Saying, I think we need 12, is it 12? Fighter jets.
Yeah. So I've got the article up here somewhere from the front page of.
I think they were F-35s that were spoken about.
Yeah, 12 new jets to carry nuclear warheads. So if you want to pop my screen up there while the Telegraph tries to pick what I want to listen to. So we're going to be buying 12 F-35A.
Yeah. There we are, F-35.
F-35A. And these ones are capable of delivering tactical nuclear bombs. And so Starmer said, in an era of radical uncertainty, we can no longer take peace for granted, which is why our government is investing in our national security. Babcock has just opened whilst we were talking about this. I'd be interested to see who it is that makes these. If anyone in the chat knows, I'm just going to try and flick through this article to try and find out who it is that makes these, but perhaps Lockheed.
Yes.
Okay. Well, they'll be worth watching on the
I
US.
say it like it's my best friend.
Lockheed.
Lockheed, of course.
But Babcock have opened 7.6% higher. Now, firmly above 11.12, and so their target price that they'd been given was a. Let me just see where that upgrade was.
I'll tell you one that I haven't seen that I do want to see. If one of you, any of you, I would give my right arm, but it's very difficult. I would like to see a B2. Okay.
A B2 in the flesh.
In the flesh. I want to touch it. I know that I'll probably get shot. Getting anywhere close to it, but I would love to see.
You're a big kind of machinery.
I like big engines, and I cannot lie.
Yeah, you're a big petrol head. Surprising about you, really.
I have been in a Typhoon.
Yeah.
I have been in an Apache. And kid you not, they trained me how to get in. There's a sliding procedure because it's very, very tight. And surrounded by all these very tall strapping.
Were they stropping?
And they weren't stroppy. They were actually quite, they were quite at ease. They said you have to be careful because the machinery in the Apache is really sharp. And lo and behold, I followed everything, but because it was my first time, I still managed to scratch my knee and there was blood because it's really tight. And they all wear wee bags because you can't go. You can't go. Just go in right into a bag.
Wow, that's true. Wow.
Yeah. It's just crazy.
I've been so interested in kind of falling down the little rabbit hole of social media coverage of the B2s. It's just they're a fascinating machine.
They are fascinating.
That Babcock price target was it was raised to 1370, now trading 1120.
Yeah.
Gavadak is saying that Rolls-Royce is breaking out again. Probably the stock of the year here in London, now trading 920. You gonna want there on the chart?
Hold on a sec. Sorry, I was trying to bring something up when you were...
Give us Rolls-Royce, please.
Rolls-Royce. This is one that has done really well. RSAX, I think you have this in your portfolio as well. The question is, when is this strong rally going to end? Lots of people ask me, and what are you looking out for when looking at Rolls-Royce?
What a stock. What
a stock, right? It's made my pain that I felt with Diageo much less on my pension. But a quick tip. I don't know whether you do this.
Go on.
But I send myself messages, and I quite like the IG system because you can actually send yourself an alert once it gets to a certain price.
Yep.
And so that's quite handy because you don't want to be looking at...
With the message as well?
Yeah.
Yeah, because often I've done it and forgot why I set it. So I need to then put the message in.
You weren't detailed enough, you see?
This is a level to call a particular client, or this is a level to go and say, this is the person who was looking at allocating to it.
Yeah.
What's also quite interesting, just while we're on this, you're actually clicking and have the price change selected there.
Yeah. But price level is kind of where...
Price level is what we were just talking about there. But price change is really interesting because if you want to know what the volatility on a stock is, and you want to know if it's moving, but you're not particularly fussed about specific levels, you just want to know if, say, the DAX has moved by 1%, it'd be worth looking at either a dip buy or a range breakout.
Yeah.
If it's, you want to know if the VIX has moved 5% because that's, clearly a market risk event, this is exactly the tool to use. So you can set this and say, I want to know whether the price is moved by a percentage, click back on price change for me. Yeah, if the price is moved by a percentage or
Nice.
by a specific number of points
Yeah.
in a time period.
Yeah.
So you can say, actually, if it moves by an amount over the day, then you're going to be only be notified if it does that across a day period on the daily candles. But you can sharpen that up to just down as low as 5 minutes.
Nice.
And that pings straight through to your phone. So yeah, really, really good one.
And this is really useful, especially when I find you have a what I call a happy stock. And because it's happy, can you see I'm going out to the daily view, to the weekly view, and then to the monthly view. Can you see that when you look to the left of the chart, from a technician's point of view, this is meteoric, right? There are no seemingly good levels, support resistance to kind of, in the near term to look at the moment. So it's been happy for a long while, which makes me a bit concerned because, stocks don't grow, trees don't grow into the sky.
Trees don't grow into the sky.
Have you not heard of that?
Unless it's a tall tree.
There are no trees that grow in the sky. What are we here? Magic faraway tree. No trees grow in the sky. Same like stocks, right? So give yourself sort of like a heads up. I always talk about the heads up display in the car. This is a great free way, people, to give yourself a good heads-up display. You can go to price change, like Luke was saying, or even price level. Sometimes I pick a price level, let's say 1,000, and I go, okay, I'm going to send myself a message, and time to check in on this stock to see, right?
Yeah, of course, it's so useful.
Apple, another one that is a good one that a lot of people ask me about. And, Apple, it's hard to see... even Issa was saying that, come on, Apple, it's got to be here forever. So is Nike, right? So he is also into Nike. Thinking maybe now is just like time to just buy. If you think it will continue to, come back and be great again, as it was back in December. But it's a good thing to almost note to yourself, and you can do this in the alerts, right? If everyone's still saying, yes, it's really expensive new model, but people still buying it, fair enough. But if some people and a growing number start to say, well, this really sucks, right?
Wow. By the way, to stop you there whilst you're on such a good little tech run, Babcock now up 12.7%.
Wow.
Racing ahead.
It is racing, because when your opening was around up 7%, right?
Correct.
Yeah.
And now up 12.8%, up at 1167 now trading.
Yeah. Taking you across to some of the others, Worldline down 10% there. Also taking a look at Lion Trust as well, because I think that is moving quite
I was just about to say about Lion Trust. So that was one of the large cap stocks that we haven't spoken about.
Down 3.
Down 3%. It was down lower. It looks like it's off the lows. And it's a UK-based investment trust. And sorry, no, it's a UK-based investing firm. They've been out with numbers this morning. Whilst we're looking at the price there, if you want to throw my screen up, the big thing, and again, this is where AI really gives you the insight as a retail trader, because you don't have to ask much of a prompt. Now, this one is actually on Google, when I've just tucked in Lion Trust AM stock holdings, and Gemini is now giving us a bit of a list on what actually they are in. So let me just zoom in on here. So
nice defensives there, Unilever,
they're very heavily focused in the UK. They've got multi-asset funds. They have some European stronghold funds. But if you look at their UK equity fund, they're focused on the main FTSE 100 players. So their numbers this morning, their gross profit came out 157.7 million. They've maintained their dividend. They've said they're confident on their outlook, but their earnings per share this year is much lower than last year. So the EPS is only 56.8 pence versus 79.2 pence last year.
Nice. I like the names there, but every time I see, especially in a trust or an equity fund, when I see Dunelm crop up, I find that very interesting. Because, have you been into a Dunelm before?
I have, and it's I consider it like a recession indicator.
Ah, interesting.
Shopping in a say an M&S for your home stuff, and then shopping in a Dunelm for your home stuff is your recession indicator, I think. Different parts of the market, of course, but a bellwether stock in the UK. You know, the other one that's similar is B&M Retail, which is very kind of similar stock in the same sector. But the market not enjoying those numbers down, now only 2.3%, so continuing to bounce there.
Yeah, and from a technical point of view, just really quickly showing this because I just did a short on this, which you can find on the Trade Live with IG site. It's called Technical Tips.
Okay.
And it's very chunkable. Lots of people say, and you know, we love all the technicals. Can you make it really short and make it engaging and easy to remember? So here, Lion Trust is a wonderful example. This is a hanging man. So you can see the 3 candles marching up, all parties going on. This is a daily chart here. And suddenly you see Luke walk in with his tie askew to the party. I'm just trying to make them remember the hanging man. And the body of the candle, this is a man, your head, with your tie askew, yes?
Right,
then, yeah.
Sorry. I thought you were saying my car tyre.
No, your tie. Your tie askew.
Right,
You
right.
doesn't really wear a tie, but
that
you know,
makes sense.
your
No,
tie,
I see it. Okay.
Right? You're looking really rough, like you've been at this stag do right, the whole week and had no. He looks great for a stag do. Do you guys not drink, y'all? And so this is a signal that wait a minute, guys, the party might be starting to change tone.
Look, it's a strong double top. Right, that is a strong kind of rejection of that 410 level, both back in where is that? Back, just give me the time on the previous high there. And look at that level. I mean, that is 410 is a strong level here that was previously acting as support, now acting as resistance.
Yeah.
Not good signs for technical bulls.
Yeah, and
You need to see a clean break for it to start to change that trend. But you are starting to see, you know, if you that kind of COVID, my brain's frazzled. You see that Liberation Day low. You are starting to see lower highs made and higher lows.
Yeah.
So yeah, that 410 level, 413, I think it is really key.
It is very key, and he's nailed the. We don't rehearse this. This is amazing. It's almost like it's rehearsed because you nailed it on the head when support becomes resistance, vice versa. That's called inverse polarity. And that's what we look for very often on the charts. Right, we have to go to fast markets, so stay where you are, pop the kettle on, get your coffee, get your toast, slam your questions here, and don't forget to like and subscribe, people. We can bring you more of this content only if you subscribe. Remember, if you came on Friday, Phil did a great job. It's like, no subscribe, no entry.
Nice. That's good. That's good.
And I was there too at the front. Right.
So how are we tracking in terms of numbers now?
We are doing really well. Yesterday we had 1,091 subscribers. What are we up to today? 1,105.
We need to find it 1,105. So I suppose the next target is now Babcock, right? Babcock's trading 11.75. We need another 50 to get there.
There we go. Yeah. Boise, thank you for that hint. Yes, I need to change up, but there is a story behind that, and it's to do with Guinness. Right.
There you
Off
go.
to fast markets. We'll come back with that story.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Hey, hey, hey!
Welcome back to Fast Markets, and we've been looking at the comments, and Gavin Ackers, I think we're going to talk about the banks for you because they're looking pretty weak today, actually. Down around, well, between them, various different bits and pieces, but of course, they are coming up to, I believe, are they coming up to earnings? Let me just take a quick look. No, I think they've spoken about earnings. There's a fantastic article, by the way, on our website from Axel, who we know, of course, is up on the show in about a couple of minutes, that we can take a little look at. So if you want to quickly fire this up on the screen, and I will zoom in on the text so that we can all see it. Mixed results. NatWest delivering a standout performance that he's highlighted and done a bit of technical analysis there. We've got Barclays being a bit more broad. Of course, they have the investment bank helping them out. And then we look at Lloyds, which is still, you know, they've got the car motor finance scandal now. You know, they had the previous PPI scandal. There's lots of bits and pieces going on. However, when we look at their share price performance, Lloyds is up the most since the start of the year, 38%.
Yeah, it's a firm favourite amongst some IG clients as well.
Oh, completely. Yeah, completely. And
So the divvy play?
for a good reason as well. I mean, if you're based in the UK and you have a pension, the chances are you're going to be exposed to the banks.
Yeah.
And finally, one that doesn't really get traded that much is HSBC, but it's one of the largest weightings in the FTSE 100, which is a little bit random there. But if we just take a look at the platform for today, what I've got here set up for you is Barclays, Lloyds, NatWest, to be read left from right. I've got the minute-by-minute candlesticks at the top here, and then I've got the dailies at the bottom.
Your eyesight is good, Luke.
Well, normally I'm not showing this on the show. Normally I'm looking at this on a screen. However, but as Gavin Ackers said, it is going to be this breakout level that we're looking at. So let me just make this full screen here. Now, one thing I've done on this is used the multi-chart tool. So if you can see my screen, if I can zoom in on this, no, I don't think it's going to behave itself. Yeah. On the chart, on all of the charts on IG, what you can do is you can click this button that's in the top left-hand corner, and you can actually look at charts on different time horizons.
Nice.
And so if you're like me in the sense that you don't want to be fighting against the longer tide, or you at least want to know where those breakout levels are, using two charts like this, it gives me, I like to think it gives me a bit of a market profile for where we are. So where are we in context? And yeah, you know, Barclays, it needs to push back above this 334 level. I'd say Lloyds has been fairly disappointing since its results, as has NatWest. So you're starting to see, you know, Barclays had good results and are pushing on. They've had a bit of a dip. They got bought strongly yesterday. I believe they were up 3 to 4%. I was selling some up at 333. I think I got filled in some yesterday for a client. Yeah, it's a set of companies that are very popularly traded, and of course we're in a very strong bull market at the moment.
Yeah. And I love how Luke is so technical and so, you know, extremely detailed. Love all of this. I'm very simple. I'm just very simple.
We need to cut that up for socials. I'm just very simple.
I am very simple. One of the key reasons why banks are also up today is because banks tend to get a lift when uncertainty goes down, right? So relatively at the moment, we talked about that ceasefire looking like it's holding, right? Anything can happen, but right now, trading the fact, ceasefire appears to be holding at the moment, which is why the UK Banks Index is up. And actually, the Barclays, the Standard Chartered of this world, whacking the chart up there, Standard Chartered up 2/3%, is, you know, they're among the top gainers in the banking space. HSBC also up, Lloyd's, and you should NatWest as well, all also up, because don't forget these banks have huge networks, especially HSBC towards to emerging markets, to Asia, all those places, and uncertainty is really bad for business, right? You get the big, pushes into the upcoming demographics who are likely to take out loans, home loans, car loans. Guess what happens to all that, trader friends, when you have a third war situation erupting in the Middle East, and you're watching that as you're thinking, shall I take out that mortgage? Right? So it's all about this shrinking process. If we see a continued, and hopefully Gavin Ackers, you're not right, you're, not that I don't want you to be right, but is it Gavin that said that the ceasefire might not hold after this weekend? One of you did on the chat.
Yep.
Then you're likely to see that banks continue to be well supported. Year to date, the sub-index, UK Banking Index, look it up some 19%.
Yeah, I mean, if we just take a quick look as well at Barclays, just because that was what we were talking about, and we look at the TipRanks Smart Score. So I've just fired it up here on the left-hand side. Is that clear enough for the show? No, it's not. Let me just move it over to here. It's showing as a 10 out of 10. So technically speaking, powered by TipRanks, who are our data assimilation partner, they're suggesting that there is a strong buy given its price currently relative to its average price target. Its fundamentals, they are growing their assets. The technicals look positive. There is momentum behind the stock, and they've got a decent return on equity. So Barclays looking fairly strong. And just for completeness, let me just show you where this is for the others. Lloyd's only a neutral, 4 out of 10, so not necessarily the most bullish of signals there. And NatWest is having mapping issues, so I can't tell you what that is just now. I will see and get IT to look at that one.
And not forgetting, taking a look at client sentiment, you always have this at your disposal. What I find really handy, I'm going to zoom in for you. The thing I like to look at most is the last hour, right? Trading activity.
Back on Standard Chartered here, just to be clear.
We are back on Standard Chartered, and for those of you that use this, I like, especially on a day when there's been, something happens at the weekend or overnight, geopolitical moves, and you want to know this, to quantify this is the IG client universe, right? Not external, but I like looking at the last hour, right? So what's happened in the last hour?
Technically the last 27 minutes, let's be honest.
Yeah, or in Trump's case, the last 5 minutes.
Yeah, we haven't got an hour's worth of data, there for you.
No.
And no signals coming through on stock.
Yeah, right.
Have we got any more in the chat for us?
Yeah, well, Diageo, let's go to the chat right now, because we had Boise saying, I don't drink. A number of young people drinking is way down. Boise, how young are you? Are you old, coming from Nottingham and 18 years old? And so I don't buy alcohol stocks like Diageo. Oh, do you have a house full of teenagers? Is that what you're saying?
Perhaps. It is interesting, though. I mean, it's definitely something that is notable.
It is. And I'm gutted because... you know why I invested in Diageo, right?
Guinness Zero.
Guinness Zero, exactly. I did a blind test. I always do these tests, as you know, almost, real story, almost accidentally, it wasn't on purpose, accidentally killed my husband with a Greg's vegan sausage roll. But, if you haven't, go and taste the Guinness Zero, because I did a blind test and was pretty darn close. I can still tell, but not after a few drinks, then I can't tell. So I thought, right, Diageo has got its fingers in the emerging markets pie, but also has these zeros that I really rate.
They're really good.
Yeah, they're really good. But also it has still, the additional still exposure to big growth markets like the US. US is still a big growth market for them, right? And their shares, I mean, this is, I'm now really, like, the pain is a bit too much, even for me. And I'm just really thinking, maybe should I just cut my losses, because it just keeps hurting me.
It does. It does. If you have a little look there, the TipRanks is just above neutral. Just above neutral at 7. If you click into view more, it's very much On the positive side, the target price average is 24.80 across the street, now trading 18.50. So the market are at least expecting a strong return here. There's been some insider trading, which is always positive, I think. There's been £112,000 worth of stock bought by insiders, and that's typically C-suite in the last 3 months, which I personally like when I'm looking at long stories. But of course, look, you can't ignore the technicals, and it is scuttling along the bottom.
It is scuttling on the technicals.
You would want to see a move higher, I think, before you buy these.
Yeah.
I don't like catching falling knives.
No.
Well, I can't because I've got a 30-day hold whenever I trade on a stock in the UK, just because of my job. But I don't like trying to catch the bottom on these things. I would rather give up 5% to try and catch it once it starts to break off of this low base. Just because you know where to put your stop loss at that point. At the moment when it keeps making new lows, you don't know where to put your stop loss, and I don't like not knowing where my risk is.
Yeah. Do you know when I thought I need to maybe get out now? Do you know when that pivotal moment was? It was when, it's not been confirmed yet, trader friends, but you heard it here first. There's a lot of talk about the US looking to clamp down on drinking, and then now there are all these, tell me if you've seen it, because I started seeing it, sobriety parties.
Okay.
Sober parties, basically.
Sober parties, yeah.
Right? It started from like the Alcoholics Anonymous, and the people who are recovering, they have these parties with alcohol. But now apparently it's catching on as a trend.
Cool. I mean, I think it is, outside of the investment space, brilliant for you. If it's something that you enjoy, and absolutely go for it. Its friends should support it. And in fact, there were people that were on our stag that weren't drinking, and that was absolutely.
That was fine.
That was
Yeah.
absolutely fine.
I like my Guinness Zero every now and again.
It's definitely a societal change that is interesting to keep an eye on. I wonder what they're going to do instead.
Yeah. On that note, sorry, Yanis, you were saying to me right, we have a break coming up. David Boise saying 40 years young. Kate Murphy as well. What's views of having more than one bank in a portfolio? Well, Luke has a client that just trades UK banks.
Yeah, and I would say the critique of that is correlations.
Yeah.
They're fairly correlated. So
Yeah.
you want to buy the stronger one. If they're going to move in lockstep, you want to buy the stronger one.
Yeah, I have Lloyd's as well, but that's a divvy play. And Andrew McKilvey mentioning he has got Lloyd's as well. Right, stay right where you are, because we have decoding charts. There's a crypto
charting
crypto with Axel. So any questions, please put it here. And don't forget to slam the like and subscribe button. Thank you so much, Luke. We'll
Thanks
see
for
you
having me.
on the floor.
See you later.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees, with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades But also remember, your losses are also amplified, so be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hello and welcome to Charting Crypto, our second week. So last week, if you remember, we talked about Bitcoin and how to analyze Bitcoin from a technical perspective. And let's just continue where we left off last week. So let's look at a daily chart, a candlestick chart of Bitcoin in US dollars. And what we can see here is basically very interesting because, let me just get rid of my, yeah, no, that's fine. Last week where we were trading around here, right in the middle of this sideways to slightly downward pointing channel, as you can see here. And I'll show you how to draw a channel in a minute. But what is interesting is that not only did we bounce off that channel on Sunday when the Bitcoin price fell with other assets as the US started to bombard Iran's nuclear facilities. And you can see that we've quite nicely risen from that low that we made on Sunday since then. So coming back to the chart, excuse me, got a frog in my throat. What is interesting, and that's why I love using technical analysis, is that basically you can see here that yes, intraday on Sunday, we went through that previous support area, but it did actually hold. So if I show you what I mean by this, can you see here the lows going back to the 12th of May together with the lows seen on the 5th of June? Can you see these lows? So what I'm doing is I'm basically drawing a rectangle between previous daily lows here on these candles, and you can see that that potentially acted as support. It did so on Saturday, and then on Sunday we went through it, but we actually closed, because the closing on this candle, as you know, with candlesticks, they are green in this case if the close is above the open, and they're red if the close is below the open. Obviously, Bitcoin trades 24 hours a day, but at these cutoff points that I'm using here with UK times, we close basically in the support area. And then, sorry again. Since then, we basically recovered very, very strongly. So what is the chart actually telling us? Well, we can see that we've had 4 days of consecutive falling prices in Bitcoin, fell through that support zone here, but we did actually hold marginally above that previous high. So previous highs also can act as support. And we stayed above this one here, this line, which is the 200-day simple moving average. And even investors who don't look at charts and don't really believe in technical analysis, and it doesn't just apply to cryptocurrencies, but also to any asset class, seem to say that if an underlying market is trading above or moving above a 200-day simply moving average, it's deemed to be longer-term bullish. If it's below it, it's deemed to be longer-term bearish. Now, it's a very crude approximation, but you can see here that the Bitcoin price in dollars remains above the 200-day simple moving average, which comes in around $96,071. Now, what we've seen here is a reversal to the upside, which was very strong on Monday on this announcement by President Trump of a ceasefire. And you can see that that candle, if we ignore all the news flow and just look at the data, you can see that that candle basically engulfed more or less the 3 previous days' bodies. And the body is simply the difference between the open and the close, these colored areas on these candlesticks. So basically what we're seeing is in one day, we've seen a reversal of the trend of the previous 3 days. So that is bullish behavior. What we're now seeing is smaller candles. So we're starting to lose upside momentum. But that can happen. It's normal for a move, which was a high volatility move, to then pause. Some people are taking profits, and then to continue or not. So for example, we had a similar situation here in June. Can you see we had a reversal on the 6th of June here, and then another candle which was smaller than the previous one, and then a small candle here, and then we had another big one. So perhaps we're seeing something similar happening here. But what is interesting from a technical perspective is the following. And this is where I'm going to show you how to use a channel. So how to correctly draw a trend channel. Well, what you do is you start off with the trend line. And you can see here, we have a series of lower highs and lower lows, despite that last move higher. And that is the definition of a downtrend, albeit a slight one. But can you see here what we can do? We take the highest point and connect our resistance line, because it's only got 2 touching points, with the next lower high. And that then gives us this resistance line. And we then move that one parallel down to the low we see here, to the lowest low of that movement. And that then often gives us a target for the future. And this is exactly where more or less Bitcoin held on Sunday. So we tested that support down here. We fell through the previous support I just showed you, that rectangle, and now we're heading back up again. And technically speaking, if we close today above the last reaction high, what is the reaction high? As you know, I always talk about reaction highs and lows. Well, it's simply a high which is higher on this candle than the one to its left and to its right. And if we close above the last reaction high, which was made on Friday at $106,531, if we do so today, that is bullish price behavior. And it would mean that technically speaking, we're heading towards the upper downtrend channel resistance line, which is this one here, which at the moment can be seen around $109,227. So that would be the next upside target. And you can see that that upside target ties in with the next higher relative high. So you can see what I'm doing is I'm sort of stacking up different technical levels to see where the market might get to next. Now, obviously, I can come up with my analysis and it could turn out to be completely wrong. So at what point, if, for example, you're holding Bitcoin, so you're long as an investment, well, at what point would it be wrong on your view? It really depends on your time frame. But imagine you bought Bitcoin on Monday, for example. At what point does the chart change direction? Well, basically what you do, you go to the left and you can see here where the last reaction low was. And you can see this is an important reaction low because we went all the way down from the 10th of June high into that Sunday low on the 22nd of June. And since then, we've gone back up again. So that is the most important reaction low. And that low, as you can see here on the chart, was made at $98,330. So basically, as long as we stay above that level, $98,330 on Bitcoin, we remain long-term bullish. Why? Because what we've seen here from the April lows is a nice uptrend, very strong uptrend. And then what we are just seeing here is a corrective move against that uptrend. And this sort of thing happens all the time. You can see it happening, for example, in the previous bull run. Can you see here? We had a phase in September to October. Then we had a sideways trading correction. Then we had another phase up, another sideways correction, and then another phase up, sideways, up, and so forth. So what we're currently seeing is just a correction. And did you see where we topped out with regards to Bitcoin? Yes, we made a new all-time high just on the 22nd of May at $111,966 nearly. And that was marginally above the highs that we made previously, the all-time highs in December, and as you can see here in January of this year. And these highs here, so that's why I always look back into the past on my charts. These highs here now in the days ahead in the short term may act as resistance. So where do they come in? As you can see, I draw in another rectangle here, and we can see now on our daily chart that this area also comes in where basically we drew in our downtrend channel. So you can see a crossover. Again, you've got different puzzle pieces coming together here. This resistance line, this previous high from the 16th of June, that previous resistance here, the rectangle made up of these previous highs. So all of that may act as resistance, at least in the short term, if we were to get there on the Bitcoin price in the next few days or so. So this is how you stagger your analysis, basically. You're trying to get the odds in your favor, and all you're looking at is basically a graphical representation of the underlying price. And the price is nothing else than the difference between buyers and sellers, demand and supply, if you want, in fundamental terms. Now, I've got a question here by David Boyce. Thank you very much for sending your questions in. The question is, the bull market support band is the indicator I use most for Bitcoin. Have you used it too? I must admit that I haven't. I don't know what a support band is, and I've been using technical analysis for over 30 years now, so maybe it's a new indicator. But as long as it makes sense from a logical point of view, then yes, use whatever works for you. But obviously, if you invest in cryptocurrencies, you need to be aware of the underlying risk of cryptocurrencies, and as we know, they are unregulated, so you could lose everything that you're investing. But also, if you look at the technical side of technical analysis, make sure that the indicators that you're using, all the different tools, in this case here, a support band, has been constructed in a way which makes logical sense. Because all these oscillators we look at, for example, as you can see here, I use very few now. I mean, when I started off in, I believe it was 1991, believe it or not, looking at charts, I basically drew all these different lines on my charts. I had a fast stochastic, I had a slow stochastic, I had a relative strength index, I had a MACD or MACD, as some people call it. And I had all these different indicators and everything, and it was just overkill. Because quite often the oscillators will give you a similar signal, but just in different, at different times. So for example, what I'm doing here at the bottom of the chart is I've drawn in a 9-period RSI. And I say period because on the daily chart, it would be a 9-day relative strength index. On an hourly chart, it would be a 9-hour, for example. So what we can see here is that also that low that we made on Sunday basically was where the previous low was made here in June. Would I have gone long, for example, Bitcoin simply because of this? No, because it's an oscillator. An oscillator is basically following the price action. It's lagging the underlying asset that you're analyzing, in this case, Bitcoin. But what we can also see is different kinds of analysis by just looking at the oscillator. We can see whether it's overbought or oversold. And we can see here, you can also draw in resistance line on the oscillator. And we can see that we've currently broken through that one. So we're basically confirming the trend line break that we are seeing on the price action itself. Here you can see we also have a resistance line, which we're testing at the moment. Can you see from this high here on the 11th of June, drawn through the 16th of June high, that currently acts as resistance. That, technically speaking, may be the reason why the Bitcoin cryptocurrency here is not advancing at the moment. It may be because of that resistance. And then once you break through a resistance line and you break above a previous relative high, that for me is a signal that, technically speaking, the odds have shifted towards further upside being seen. So enough about Bitcoin. Let's look at another one. How about Ether? Let's look at a new one here. So this is what I had on my chart last week. I haven't touched it since, and you can see here what I've done is basically drawn in previous support levels, the support area. I should have actually done it this way here. with these lows, and you can see we clearly fell through the support, and now we're back above it. But because we fell through this in a sort of a more significant distance than that what we saw on the Bitcoin chart, I believe that we can now remove. This previous high here, we can say, well, that's our resistance ahead of the all-time high, these previous highs, and this high here. So that we can leave on there. And yes, I mean, you could say, okay, this whole area here going all the way back up to 2,468 back in, no, 2,879, sorry, in June, could be our resistance area. Fine, but you know, if you've got several touching points here which are close by, these highs here, then for me that is the resistance area. So what can we see? We can also see this uptrend line here. It's a support line because it's a tentative uptrend line. We've only got 2 touching points here. That was fallen through, and Ethereum, Ether, the cryptocurrency, then fell through that uptrend line and through and close below this previous reaction low. So for me, that was then a valid trend line break. So this trend line we have to remove because we've broken through it. But what do we do with this one? We've got this one still up here, and you can see I left it on the chart. And basically, we did fall through that uptrend line. So, you know, intraday investor might have thought, oh, it's a trend line break, it's going to go down. And even those who look at it from a closing basis could have said, oh, Ether closed below this uptrend line, therefore it's going to go all the way down again. But that is incorrect. For me, what is far more important is a trend line break. So in this case, this would be, on a closing basis on Sunday, a valid trend line break. But I go to my left of my charts, I want to see a close below the next lower relative low. Now in this case, it's a long way away, it's down here. But that means we haven't closed below there, so it's not a valid trend line break, it's per se. Plus, if you look at the pattern of a decline, can you see here what we're seeing is potentially what is called an Elliott wave ABC correction and a zigzag correction. What it is from the high, you go down, back up again, and down by a similar distance, slightly longer than the previous one in this case. From there to there, this distance here is projected lower from that high here. So that's wave A, wave B, wave C. You don't need to know all of that. All you need to look at is the pattern. Have you got to move down, up, towards maybe half of that move, and then back down again? That quite often is a corrective move, because an impulsive move, that's a move that moves very quickly in the direction of the trend, like we did here, for example, at the beginning of May. So what do we do? This trend line clearly is no longer valid. Well, it's normal for trends when they lose momentum to become flatter. So all you do is you make sure you have no data going through your trend line. You basically just put it to the lowest point. So now we've got 2 touching points, but because this one's quite close, we could actually say, no, it's actually a valid trend line. It nearly has 3 touching points. So in this case, this uptrend is still valid. That could be a corrective move. Could we go higher now? So what we do is we actually look at another resistance line from the top, which we draw through the next lower one. Can you see here? Had I done that, this would be incorrect, because can you see here, I've got the shadow of this candle going through the downtrend line. So what I need to make sure is that all the data is within or below that downtrend line or that resistance line. So in this case, this is the case. But yesterday, we managed to break through that downtrend line, and we touched the 55-day simply moving average, which I use instead of the 50-day moving average. It's just a preference. But here, we are in the process of breaking through that downtrend line. Now, if we were to manage to break through it, what is important? Well, we need to break above the previous relative high as well. So we need not only to see a trend line break, but also a move above this high here from the 20th of June. That was made at $2,569 approximately. Once we see that, and by the way, we've got this red line here, which is a 200-day simply moving average. Well, once that happens, then it's very likely that that uptrend that we've started at the beginning of this week is to continue. And in that case, what are we targeting? The previous highs. So these highs here, this major resistance area. Now, as I said before, that might be the projection from the charts, but it might turn out to be wrong. So if you're a holder or an investor in Ethereum, at what point are you wrong? Same as with Bitcoin. If we fall below the previous low here, below Sunday's low at $2,115.55, then you're probably wrong. In this case, it would then probably slide further towards this support area here, seen at the beginning of May. Now, there's a quick question on Coinbase. I've only got a few minutes left. Coinbase, I'm not going to cover today. Let's do that tomorrow. Not tomorrow, next week on Wednesday. Sorry, we've run out of time because we've got other presenters coming after me, but I'm going to talk about Coinbase next time around. Thanks a lot. Bye. See you next week.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Hey, trader friends, welcome back. We are 2 minutes to the all sessions opening bell, my favorite part of the show, because nowhere else can you get sort of the insight ahead of the opening bell for all sessions. And also we have, of course, the ability on the IG platform to take your position ahead of the US cash open. So just setting this up so that we are sitting pretty here. Andrew McKilvey, call out to Andrew McKilvey there, because glad that you like the early indications section. Takes me some time, a bit tricky with so many people away, but we take great pains, so I do indeed, to try and get all this written in a script. So you can ask Luke, I go over there quite often to try and build these data scrapers so that I can get that easily curated in the morning so that I can give it to people like yourselves. It helps you get early heads up, just like your heads up display in the car. So how much time have we got to go, Yanis? Right, 30 seconds to go. Just taking you across some of the key things that have happened whilst we were chatting. The ceasefire now still looking like it's holding at the moment. We're getting some comments out of Merz from Germany, saying that Russia is threatening the security of the continent, and they'll decide that NATO will get 3.5% and 1.5% additionally. 2, 1, and here we go. Right, that bell that will soon be sponsored, hopefully by the London Stock Exchange or Greg's or anyone really, anyone you can put forward, because you know, we really would like a much bigger bell. So let's have a look at where we're at for all sessions. It is shaking out there, and we have Ocugen up 4.3% there. Reddit as well, top of the winners list, up 4%. Virgin Galactic, talking about space stocks, and Luke is going to send through that article from the FT a bit later on. That's also Virgin Galactic, also up more than 2%. We also have some of the consumer names that are higher. JD.com is actually up as we speak, and NEO as well is up 1% there. Some of the crypto-related stocks are also higher, just calling out Micron Technology, the Micron Technology, and also just taking a look lower down, I see Delta Airlines also still adding to gains after that brief rally after we are seeing the ceasefire hold. Taking a look at the losers list as well for you. Has to be said, it's more a risk on day for the markets in general, and also all sessions. But we are seeing on the losers list here Novo Nordisk topping the losers list, down 1.4% there. Not a big surprise given Novo Nordisk now seeing quite a bit of headwinds in terms of the obesity and skinny pen space. That was always going to happen. You know, first you get these stocks ride the wave of, you know, first comer into that space, and then after, as their patterns wear off, you get more competition, you know, they're likely to plateau a bit. So we're seeing a normalization in Novo Nordisk's stock there. Best Buy, General Motors also down 8% there. And also we have Palantir down 0.2%. Not much to report there. Let's head back to the indices just to give you a quick overview of where we are at the moment. And it's looking flat or higher as we see this tentative Middle East truce holding. Lots of people, of course, keeping an eye on some of these hostilities still. Of course, it is a very serious situation there. But at the moment, it looks like the ceasefire, although shaky, is still holding. Israel saying that it will respond forcefully to Iranian missile strikes that came after Trump announced that end to the hostilities. Also checking in on the forex side of things, the dollar. Checking on the dollar basket, it is up slightly as we speak there. Adding that to my workspace, not by much though. Dollar still really stuck in that 97 to 98 level there. Dollar weakening after JP. We haven't covered this much in the show just yet, but just giving you a synopsis. Powell, JP, saying that he and many at the Fed expect inflation to start accelerating soon, and that the central bank, though, was in no rush to ease borrowing costs. This could be in response to some of the comments coming from some Fed officials recently, Bowman, one of them, saying that perhaps it could be time to start easing, or the suggestion was that, which was a surprise because she tends to be a hawk normally. Also taking a look at the commodities space, if we may. How much time we got, Yanis? Right, plenty of time. We have 6 minutes there in the commodities space. Zooming in for you so you can see that WTI is up 1.3% there, and also Brent crude following that higher 1.2% there. Gold is up slightly, has to be said, but you know, not a surprise there either, because we had gold easing off yesterday. Markets, of course, in a previous session, seemingly shrugging off the hostilities there. It does seem at the moment, this could change, remember, trader friends, in a heartbeat, because we're in that world right now with Trump and tweets and firing and starting an attack without the nod from Congress. So we are in that time at the moment. So this could change, but at the moment, what the market is suggesting is that they are looking at the ceasefire holding, at least for now. Also, don't forget, looking lower down at the commodities space, a softer US dollar, of course, makes commodities and dollar price metals more attractive, right, for buyers using other currencies. So looking out there, you know, copper is up, well supported, up 0.2% there. We talked about copper yesterday as well with Scotty, who was here, Scotty Byrne, who is ex-CS, ex-Credit Suisse. But we also said if you're trading copper, make sure you keep an eye on the copper demand from China. It's the biggest consumer. And quickly, just before we go, there are some other key things that I'd like to get you across as well, because it has been quite an interesting day on the movers. Banks have had a good day. Let's see if they're still holding. HSBC is still up 0.5% there, and also Lloyd's, one that is very well traded here at IG, is now actually down, 0.75%. Let's see if Standard Chartered has held. Standard Chartered, there we are, and it has, but it has eased off. It's given back some of the earlier gains there as well. Really, really interesting space. Let's have a look elsewhere now to see whether we can pick out some of these individual movers for you. Looking earlier, we had Stellantis, which was moving rapidly higher. Let's have a look at that to see whether that has moved. Stellantis. Yep, it's still up. Let's have a look at that. Adding that to my workspace for you trader friends. That is the daily chart. It is up 5%. But looking on the minute side of things, yes, it is still climbing there, as you can see. So Stellantis still looking bullish there. Whilst we're in the auto space, another one that is zooming in early trade is the great Ferrari. Let's have a look at that. Ferrari. Actually on my screen, not showing, Ferrari is not showing up there, but I'm seeing it on a different screen saying that it is up in early trade. Let's have a look at Babcock as well, because we heard Luke talk a great deal about Babcock earlier. Babcock is still up, strongly up 11.7% there. Tell us what we are trading or investing in this morning. Please slam it on the left-hand side here, and we will cover that across the board as well. Let's have a look at the luxury space whilst we're at it. Here we are, luxury. And we've got except for Kering and Swatch as well, the others seem to be having a good time. Burberry's shares, which I haven't got here, but I will add that. Burberry, let's have a look at that. Burberry is up 5.5% there, and this move higher coming after a broker upgraded its target price. Plenty of moves due to upgrades and downgrades today. Also, having a look at all sessions for bigger beers, asking about Tesla. Let's have a look at that. Monkey Man is off to the cricket. Hope you have a good time. Take a picture for us, Monkey Man, because we like to see it. You can still listen in to us en route there. Tesla, all sessions, up just a touch, but you can see that, you know, the move higher was then followed by a move lower, corrective negative 4.4% there. And it seems to be coming back up now. So that is quite something that is a bit of a trend at the moment. We're seeing a lot of volatility with Tesla, but it looks like the creep up, the gentle creep up since the April low seems to be still largely in place, at least from a technical view. Just a few minutes left for me to get through some of the other big movers as well. Halfords is down 1.5% there, and Halfords, this is after reporting underlying pre-tax profit above market estimates, but the investors still not liking that news. So perhaps this is also maybe some profit taking there. As you can see, this is the daily chart there. Taking a look at the 5-minute chart, so you can see the move there. It's now come off quite a bit and gone below the moving averages. And if you look at the daily chart as well, it has in the last few sessions started to come and cross below the 20-day moving average. So bing, red flag. Keep an eye on that one. That is one to watch. Gavin Acker is saying, could you take a look at Micron? I believe you're talking about Micron. Here we are, Micron Technology, adding that to the workspace. Micron, I believe, Gavin Ackers, correct me if I'm wrong, out with numbers, that's right. And it is looking bullish. And from a technical viewpoint, Gavin, just drawing that out so that all our viewer friends can see as well. I'm going to do it quite slowly because when I met a lot of you on Friday evening, one of the key feedbacks that I had was it was nice to hear that a lot of you enjoyed watching me draw, albeit badly, on air, but also I do it a lot slower because you know, if I'm trying to learn something new, especially online, I like to take it quite slow. And then, you know, later on, once I get a bit more sort of advanced in it, whether it's to do with, I'm, you know, taking another course right now on digital and AI and how to use AI in trading, I tend to stick with courses that kind of handhold, but in a much slower way. Plus, I find that it's easily digestible. You can always fast forward, right? So upward trend here, firmly in play, and also nice volume there. Also, what I like to do is to whack up the RSI. And as you hear Axel and I say very often, you know, it's not necessarily something you trade on. It just gives you a heads up display as to whether, you know, we're looking at overbought territory or oversold. And at the moment you're seeing that yes, it is suggesting it is overbought, but with so many green candles that are in that move higher, it would suggest that there is more bullish momentum. So all this means is the bulls are in charge rather than the bears. And then having a look elsewhere at Micron, I also like having a look at the Ichimoku. You hear me talk a lot about this because it is a nice snapshot. I mean, it gives you a good overview of where this is without you having to draw too much. And even if I, got rid of the RSI so you can see a bit clearer. It is above the cloud, which also suggests bullish momentum. If you start seeing it cross below the cloud, that is a almost like a red flag, time to take note and perhaps switch gear. But at the moment it's above the cloud, which suggests bullish momentum. If it's below, then it's bearish. But at the moment for Micron Technology, it is above. And then just taking a look, because I do use other bits of software that I have at my disposal. And I use, for fundamentals, I use LSEG Worktop. And I hear you asking, what else do you use? I also use Bloomberg, because once you learn how to use a Bloomberg terminal, you never really forget. It's like riding a bicycle. I like to see a healthy amount of upgrades before an earnings report, Gavin. So what I'm looking out for is 2 weeks before this coming earnings, I like to see a good amount of price target upgrades. And here you have it. If you look, I'm sure you can find this online as well. Bernstein raised its price target this week on Micron. We also had Wedbush. And the other one was Wells Fargo, 20th of June, and they also raised their price target to 150 from 130. Earlier in June as well, you can also Google this, or I can send this to you. What I liked when I saw it cross the headlines is Trump administration looking to expand its spending in leading edge DRAM manufacturing and R&D. So increased, spending in the space can only be good for the likes of Micron Technology and the rest of the sector, right? So good mood music there. For me, if I had to stake my flag, I'd say that this is showing me bullish momentum, at least for the moment, looking at the charts and the near term upgrades and downgrades picture. Hope that helps a lot. Yes, Micron earnings is tonight. That's right. And we have a few others too, Boise. Let me just get them up for you. So Micron is later tonight, but we also have General Mills and I believe Paychecks, but I don't really cover that one very much. But General Mills also later today. Right, we're going to have to wrap here. Any more questions, do slam in the chat and also hit the like and subscribe button. And if you want to ask me questions later, you can always get me at ask@ig.com. We will see you quite soon. Let's give us a heads up as to what other things that are useful. For example, a lot of people ask me, Ange, what made you so sure that oil and that short called by Dylan was going to be something that is probably, we all talk about probabilities here because nothing is guaranteed, but in terms of probability, and we like to talk about directional trade, is probably going to come to pass that the short is the right way to go. Well, look up marine traffic, because there's a really cool app called Marine Traffic, which I can show you tomorrow, but it shows all the ships that go through the Straits of Hormuz. And boy, if you look at it right now, or yesterday or the day before, it is still looking very busy. Right, and on that note, do stay on, because we have interviews with Michael Seen after this, and of course that talking shop about how to use AI in a more clever and efficient way to help you and your investing.
I have Mike Singh in with me this morning, former Managing Director at Goldman Sachs and Head of Execution Sales, but now, well, first of all, welcome.
Thank you very much.
Tell us.
Pleasure to be here. My first day on TV ever, so please be kind to me.
We can't promise that.
Yeah.
But yeah, we talk a lot about buybacks on this show. This is the #1 expert on buybacks in this country, if not more.
I think you're being very generous. I would definitely not say that, but yeah, I'm trying.
And you've branched out into your own business, haven't you?
Yep.
Which is, we call it an advisory.
Technically, I'm a consultant.
Consultant.
In order to be an advisory, I need to be licensed, and I haven't set my business up as a licensed regulatory body just right now, not for any particular reason, but I don't need it currently. So I consult.
A consultant, and really diving deep into why, well, one of the things that you're looking at the moment is why this country trades at such a discount, the stock market, the companies, and what can be done about that. In fact, we can put your latest piece of work here. This is a publication about time to tilt the scales, a call to help UK capital markets.
Yep.
Now, give us a bit of background, and then what this takes us.
Sure. So by background, I'm an equity execution guy. So what that means is historically, I've helped investors when they make a decision to buy or sell a security. Don't ask me what you should buy or sell. I'm hopeless at that. But once they've made that decision, how to efficiently transact it. And by efficient, what we're really looking at is, how to not spend as much money as you otherwise would. So if you've got £100 and you want to try and buy, whatever it is, Vodafone, I want you to try and help you buy as many shares as possible for that £100, including all of the transaction costs and all those sort of things, and just try and do that efficiently.
Yeah.
So since, I sort of have spent 30 years helping customers do that in various different ways across lots of different types of customers, lots of different ways of transacting, from portfolio trading, algorithmic trading, etc. My last role, I was running the execution service of a relatively small business, and we sold that business to a very large investment bank.
And was that Redburn?
It was involved in helping to manage Redburn, and I was responsible for their execution services.
Right.
And we sold that business to a company called Rothschild and Co.
Right.
And in that transaction, one of the things that the Rothschild and Co. bankers wanted me and my execution team to help them with was to build pitch books to sell the execution services of the new broker that they had bought. What was going to become their equity department, if you like, to try and help corporates do transactions. And it was, they were interested in pitch books to try and help with share buybacks.
Yeah.
And that was when I sort of first had a real proper look at and trying to understand, how does the market execute buybacks and how are things set up. I'd done a little bit before, but really I wasn't really involved.
Because it is very complex, isn't it? But I remember, so 2011 it must have been, I was doing Rio Tinto's buyback.
Yep.
So about $2 billion over the 12 months.
Yep.
But we were buying up to 100,000 shares a day with a target of the VWAP. And anybody who doesn't know VWAP, it's a very technical term used in banking that is just the volume weighted average price. So my target was to beat this average price during the day, but you could cheat, because if the stock went down, then the company would just send another 50,000 shares to buy. So you always looked good against this VWAP.
Yeah.
And there is a lot of ways that banks are helping themselves look very good in these transactions, isn't it? And the cost that you detail in this article is astronomical.
So, I mean, if we go back traditionally, which in 18 months to December.
And that's
this year.
Takeovers.
Correct. Delistings, moving listings, takeovers, take privates, M&A, all of that stuff combined. And it's devastating from the UK's perspective because our financial service industry, whether you're in private equity or whether you're in public equity, whether you're in debt or anything, we need to have healthy public markets to be able to function. And the first thing you need for a healthy public market is investors willing to risk their capital. They expect a healthy return. In order to be able to risk their capital, right? If they get a better return for the same risk somewhere else, they will do that. And the second thing you need is companies who are looking for that capital to come and regenerate your public market so that we have more companies coming to market than leaving our market. Otherwise, we shrink to zero. And that has has an awful negative value to our country, right? So it's really important, much that people will like to dislike people in financial services, it is a pretty critical business in our economy in general.
That's what my mother always said. She said, you don't listen to these people that say about you being a bad banker. Look at all the tax that you in the first place. And your publication does actually go through the reasons for that.
So I'm an execution guy. I'm not a capital allocation guy within a company. So don't take it from me. But this is kind of what I've learned, and I'm very early on my learning curve from a corporate finance perspective. But if a company has excess capital, so it can afford to return some of that capital to shareholders, then it has two choices. It can return it via dividends, or it can return it via share buybacks. And there are reasons why share buybacks may be more favorable or dividends may be more favorable. But generically speaking, if your company is trading, the share price of your company is trading at a discount to what people think is the fair valuation, then share buybacks they transfer wealth to the remaining shareholders from the shareholders who choose to sell.
And you do that because you're reducing the share count.
The share count. So if you've got a company which has got 100 shares outstanding, and it wants to return £100 to those shareholders. If it did it via a dividend, each shareholder would receive £1. Right? It's pretty simple. So imagine you owned 10 of these shares, so you are a 10% holder. If it wants to return the same £100 but do it via a buyback, it has to go and buy those shares from the share register, from the shareholders, and it can do that in a number of ways. If it does it through the market, what we would call an open market transaction, you can't actually buy the share from the selling shareholder because the selling shareholders will sell it to the market and you as a company have to buy it from the market, which is where these rules you were coming into talking about before. Right? There are rules as to how as a company, you're allowed to buy the shares so that you don't get accused of manipulating your own share price, those sorts of things. So, when 4% in total. That's a lot for the market.
And that's just the 4% compared with the US, and it might be going on there as well.
Oh, there's games going on in the US too, for sure. The US is not a perfect model, but I picked it because it's deemed to be a more competitive market.
Yeah.
So that's the, and also I could find the data for somebody else's work.
Yeah, why is there a 4% gap, Andrew McKelvey's asking, between the UK and the USA, and is it being sorted?
Okay, there isn't a 4% gap. This is me estimating a 4% gap, so it's not factually right process. So I think the reasons why, okay, well, I think the fundamental, most obvious reason why there's a big gap is what we would call information leakage. So these transactions are big. If you're a US listed company and you want to do a buyback, your board has made a decision and approved a decision to return capital via a buyback. The only disclosure you need to make is when the board makes the approval, which is a permission to the executives that you can do a buyback. And that's disclosed through AGMs and publicly disclosed, as it should be, right? We can't have a company transacting in its own shares without the shareholders knowing. That would be very unfair. Yeah. But now that's a permission. They don't need to do the transaction. They have an option to, or a choice to do so. And if they choose to do so, they don't have to tell the market until their 10Ks and 10Qs, so quarterly numbers after the fact. So, there's an advantage when you're trying to buy £1 billion of something that the market doesn't know you're starting to. Okay?
Absolutely.
So in the UK, the way we've set up our safe harbor rules and where companies get the legal protection from being litigated against or challenged from a legal perspective, the rules say that if you want to do a share buyback and stay within the safe harbor, when you take that permission from your board and turn it into an intention to buy, before you buy a single share, you have to disclose. So what you'll see in what we call the regulatory news, so the RNS, we've
got an example here. We'll pop Vodafone up.
Okay.
And you can see, this. Not only do you get the pre-announcement that it's going to happen, but you also get daily, down to the very share, how many shares they've bought, which means people like me and our other viewers can try and take advantage of it.
Correct.
Because we know on a half-day bank holiday going into Christmas, they're trying to buy a whole day's worth of shares.
Maybe.
And the stock goes up 3%.
They don't have to, but they can.
Well, that is what happened.
Yeah. But the point is that before a company has to buy a single share, they have to tell the market, we're going to start buying £1 billion of our own shares, or whatever the number is, today. We expect to finish, there's a series of things, minimum things they have to explain. And then every day that they do a transaction, they have to update the market on how the transaction is done. And if you look, you'll also find what we would call every single X lot. So every single child order. So, at 8:04 in the morning, right after the market is opened, the company might buy 1,000 shares from the London Stock Exchange, and at 8:05 they might buy 1,200 shares from Aquis, and you have to disclose all of this. So anybody who knows what they're looking at, so you and me, we spend our lives in this stuff, get a very, very good idea of what's going on. And that does lead to opportunities for totally legal front running, which I think is not the way that we should design the market if we want to try and protect the long-term investor. Absolutely. So the question to the regulator really is, who are you trying to protect? And you have to make some judgment balances as to who you're trying to protect. I think this particular disclosure law is excellent insofar as they're the best disclosure laws in the world, in my opinion.
For transparency.
From a transparency perspective. But the cost of having it near live has a tremendous cost on the company and therefore the remaining shareholders within the company. So I would propose that we keep the level of transparency, but we delay the information so that you get it a quarter later or something like that, so that the value of the transparency is there, but the trading value has diminished. Those sorts of things. Now, I'm just proposing it. It's not like I've based this on any fantastic study which would say this is the optimal one, but I'm just saying it will be an awful lot better. And it's the same as what we have in the US, so it's an easy thing to copy.
Yeah. And it's just like when we used to get taken out of $50 million of something, then you could keep the print back for a certain number of hours until the next day.
That's the scale of these transactions, so is just dramatically bigger. The single biggest orders in our market, on the buy side certainly, are share buybacks, without a shadow of a doubt, in aggregate. So in answer to your question, the 4%, or I think a lot of the differential between the UK and the US is to do with this disclosure stuff. There's other reasons. There's two other reasons, I think. One is the execution products, but to be frank, they're no better in the US, but it contributes to the total cost. In fact, you could argue that they're worse in the US. I don't know why I'm pointing over here for the US, but where I sit at home, this way is west. And then the other one is the way that we've designed the access. So if you want to try and buy a lot of things from sellers, you need to try and find where are the sellers going to be selling it. And within our market, as you probably understand, your listeners probably understand, we have lots of different mini exchanges within the market. Yeah. So we've got London Stock, we've got these things called dark pools, and all these sorts of things. You want to be able to go where you can buy the shares from the sellers, and most of the sellers over time tend to be the professional money managers is where most, not all, but if you go and look, by percentage of ownership, the vast majority is owned by professional. Yeah. So you want to be able to go there.
And then just going back to Maturin's question, so to underline your view and the view of obviously the companies as well, it does benefit the company if they perceive the share to be worth less than the market or worth less than the valuation would otherwise suggest. So cancelling the shares does help you have a bigger EPS.
It does, yeah. So if I can steal from Warren Buffett and just explain that why it makes sense and when it makes sense to do a buyback and when it doesn't. So if we take Warren Buffett, and apologies, Mr. Buffett, because I'm gonna steal your idea and probably get it. I'm probably
far worse.
I'll probably get it wrong. So imagine we have a 3-share company. You own 1 share, I own 1 share, and Mr. Buffett owns 1 share. So it's a 3-share company. And the total value of the company is £3,000. Okay. Right? So we don't need to worry about how we value this company. You don't need a super analyst to come and forecast future earnings and do discounted cash flows or you know exactly what the value is. It's £3,000. There's no question. And the company wants to do a buyback, and I choose to sell my share. My share has a value, the moment per share value, of £1,000. Yep. But the company, says, Mike, we'll offer you £800. And say I really need the money because I need school fees or something like that, whatever it is, and I sell at £800. Okay. What's happened is, and the company then buys that share, cancels it, so it becomes a 2-share company, and I take £800. Yep. What you get left with is a 2-share company, so which has got a market cap of 2 shares times 800 is the price, right? So it's a £1,600 market cap company based off the last price, but it has a value of £2,200.
A perceived value.
Correct. Now you used to own a third of it. You now own 50% of this, right? You owned 1 share at the start, 1 share at the end, but the value of your share, not the price, has gone up from, your ownership of the company has gone up from £1,000 to £1,100, right? So the point is that if the company, it was the company that bought my share, not you, not Mr. Buffett, the company, if the company buys my share below its intrinsic value or its asset value or its NAV, whatever value process you're using, then it transfers wealth from the seller to the remaining shareholders because you own the share. Now, if we did it the other way around and I agreed to sell my share to the company at £1,200, then the residual company is worth, whatever that is, 1,800, and your shares are worth 900 each. Yeah. Right? So the value transfer happens the other way. Got it. So it's really important at a board level, and I think boards really understand this very well, is that if you're going to approve a buyback, you should only approve it at a price which you have reasonable confidence that it's at a discount or at least not higher than the value of the company.
And that's one of your main arguments, because so Mike has an amazing LinkedIn that he produces a lot of publications, research, and
research would be generous, yeah. Opinions. Wait. Yeah.
But you take real situations where you've seen what the details are, and cannot believe that these companies have paid.
Yeah, no, it's less to do with, I have no idea what valuation is. I mean, in theory, I know what it is, but I'm not an analyst. I wouldn't be able to tell you if Vodafone is undervalued or overvalued. I wouldn't have a clue.
Yeah, or BAT.
BAT or anything, right? Yeah. But what I do understand is how to efficiently transact. So maybe I should explain. One of the things I'm very critical of is that there is a subset of structured products which typically investment banks sell to corporates, which are very, very clever and look fantastic, but there are a whole series of tricks. And I mean a whole series of tricks. Maybe I should explain that. Okay, so the key component within all of this process is, what is the execution benchmark, which is used to calculate if the execution was better or worse than, and often the profitability for the broker, the fees are arranged from a performance perspective, so that they make more money if the execution is better than the benchmark. And the standard benchmark is what's called the arithmetic average of the daily share price. So if you have £100 million, and let's say you agree it's going to take 100 days to transact, what that means is that you would effectively end up buying £1 worth of shares every day for 100 days. Okay. Now, the important bit is that in the contract, it's very, very clear. It says that we will guarantee an outperformance or a match of performance to the arithmetic average of the daily share price. Now, the arithmetic average, or simple average of the daily share price, is day 1 plus day 2 plus day 3 plus day all the way up to day 100 is that share price summed divided by 100
days.
And that's the arithmetic average. It's a common average that we all think. Now, the trick is that I was looking this up. I'd put it in ChatGPT, how many different averages are there in the world? And it came up with 13, but said there's a whole bunch more. So you've got medians, you've got Bayesian mean, you've got all sorts of averages. The trick is in understanding that. So can I try and explain just the difference and where the trick is from that process?
Please.
Okay, so imagine we've got a super simple, so I'm going to pick a really super simple example. You have £200 to buy in a share buyback. And because this particular share I'm going to pick has extremely high share price volatility, which means the share price might be 50 one day, 100 the next day, 30 the next, right? It's going all over the place. And I'm deliberately doing that just to be able to show you in the maths. And, you agree with your boss, look, because this thing is moving around so much and I have to buy £200 worth, I'm going to buy £100 on day 1, and then let's wait a month, say, and then I'll buy £100 of shares on day 2. And you agree with your boss that, okay, what a good outcome would be if you beat the average. Okay, so you come to me and I say, I've got a fantastic product for you. Okay, so I understand the problem. You've got £200 to spend. You want to spend £100 on 2 different days. I'll tell you what, I will guarantee you a 1% discount to the average price over those 2 days.
Okay.
Deal. Yep. Okay, you're happy with that, okay? So just to be clear, if the share price is 98 on day 1 and 102 on day 2, the average price will be 100, and I will guarantee you that I will sell you shares at £99. So you will buy them at £99 per share, 99p, right? So that's a 1% discount. Happy? Right, should we sign the contract?
Deal.
What I've agreed, and you agreed with me, is the arithmetic average of the share price. Okay, now let's look at what happens. So on day 1, we spend £100 at £50 per share, and I'm going to end up buying 2 shares. Okay? First of all, let me just ask you, do you think I lost money or I made money in this transaction? Optically, it looks like I lost money, right? Because, the average is 75, and you bought them at 74 and a bit. 0.3, whatever the number is.
Okay, so the company looks clever.
So it looks like this was the average price, and you bought them at just below the average, 1% below. So do you think I've made money or lost money?
You as the...
Me as the broker.
The broker.
Guaranteed you this 1% discount to the average.
Well, it looks like you've lost money.
Optically, it looks like I've lost money. Okay, I would agree with you. And this is what I was feeling. I only figured this bit out this week.
Right.
Which I can't believe. I read about this 3 years ago, but I only... I have a sort of a degree in maths, different stories, sort of. So I thought I understand averages, which is the arrogance of knowing stuff, right?
Yeah.
So on day one, I have bought 2 shares. On day 2, I spent £100 at 100, so I buy 1 share.
Yeah.
So in total, I have spent £200 and I've bought 3 shares. What's the average purchase price? It's 66.
Yeah.
Okay, so I've 0.6, whatever. So I've bought shares at £66 and I've sold them to you at £74. So I've made 11, 12%, whatever that difference is.
Yeah, huge.
But it looks like magic. Yeah. Now, it's because the arithmetic average is not the representation of what you would get if you spent the same value every day for 100 days, or for whatever the number was, or for 2 days. That average is called a harmonic average,
Right.
which I'd never heard of until this week.
So the harmonic average is generally lower than the...
The harmonic average cannot ever mathematically be higher than the arithmetic average or the simple average.
We saw this happen because in VOD's buyback, and we track the number of shares every day, they had an average of 16 million to buy a day. And it was perhaps one of your former employers that was doing it. And they came out and they bought 30 million shares day one. And I was, wow, they're only meant to buy 16. 30 million shares day 2.
Yeah.
Day 3, 36 million shares. And I could not understand, but that was at 66 pence. Next thing, the share was 70p.
Well, yeah, the point I'm trying to make is that would require predicting the share price. That is, there is a genuine risk in this. This one, I didn't do anything clever as the broker. I just executed, £100 a day at the market price. So the difference between...
Sorry, that's why you bought 2 lots of 50.
This is why I bought 2 lots of £100.
Right, gotcha.
So the point I'm trying to make is that the cleverness in the contracts at their very base level, before you start to add all the bells and whistles, which trust me, these things get super complicated. But before you even start, like the broker, by taking 0 risk, is guaranteed to not lose money. I mean, assuming that the share price is more volatile than the 1%. But if I guaranteed, no discount, but I'll guarantee you can never be, and you said yes, then what I've done is I've basically given you a simple average when I know that I'm going to get the harmonic average. And I know by definition, because of mathematically, it's impossible for the harmonic average to be higher. And I'm buying
the light bulb went when I realised you were promising to buy 100, you were spending £100 a day.
Pound is the value. Yeah, if I'd spent shares, it's different, right? But
so you need
because
to
it's a value, exactly. So that strategy, execution strategy, where you spend the same value every single day, is called a pound cost averaging or a dollar cost averaging. And the correct way to calculate the price at which you will buy the shares is the harmonic average.
Got it.
Not there. So all of these contracts, of which I don't know what portion, but I'm told it's a very significant portion of the £60 billion a year here, the 250 billion euros across Europe, the $1 trillion in the US, use this benchmark, which is the mathematically incorrect benchmark for a dollar cost or pound cost average price. So I don't know how you feel about this process, but when I figured this out, I felt a bit cheated. I'm like, okay, well, the guy just cheated. His or her understanding of the fact that it's like, if you ask me what's a Bayesian average, I wouldn't even know where to start. I just don't know. But because I don't normally do this stuff, they've taken advantage of my ignorance for no risk as the starting point, and then they build risk onto it and all this thing.
But made it look good.
So I think there's a problem coming in the market because of this sort of stuff. Because the amount of money we're talking about is enormous. I mean, genuinely enormous amount of money.
Now, Mike, you've got a website. We're going to have to dash, but if we can just show the website there up, and it is candorpartners.net.
Yep, candorpartners.net.
And people can add you on LinkedIn.
And if I can make a wish, if you're a company board, I genuinely think that you need help insofar as an expert sitting beside you who understands some of the way execution, because if I can't predict what will happen, but it doesn't take a rocket science to figure out that there could be some legal action coming at some point in some way. And I think it's the board members who are technically at risk for this stuff, because they are unwittingly just they don't know the right questions to ask.
Yeah.
And so my business is to try and help boards and investors in companies make sure that when a company is trying to return capital to its shareholders, as much of that capital returns to the shareholders and improves shareholder return, and less of it goes to the intermediaries who, whose game it is to try and extract as much of that value as possible. So that's my business, and I would love to be able to help.
Michael, thanks so much.
Thank you very much.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Another episode of Talking Shop here with IG. I am your host for this particular session. I'm Luke Moore. It's lovely to be here. And I've got Mini-Me with me this morning.
Exactly, the other half of the Moron Trading Show.
So look, the Moron podcast is commissioned. We're back for a second episode. And I think this one's going to be quite interesting. So we've used AI on desk now, for quite a while, probably for the last
year or two.
Specifically, I think we've kind of dived into much more in the last 6 months. And I know it's something that gets bounded around all the time. But in reality, how do people use it? Okay,
Exactly.
I think if you speak to the average person on the street, they know what AI is, they've heard of ChatGPT. But actually, in the case of using it, I don't think adoption's anywhere near where it could be, and what people can use this technology for free to help them out with.
Yep.
So what I wanted to do and what we wanted to set this up is, how do we help you? How do we give you the foundations on a couple of models, a couple of tools that are free to use? How do we use them? Specifically, how can you use them to help your trading? That's the most important part. How can you take these tools and use it as your tech stack? How can you set yourself up and stand up against the big boys, right? And the most obvious one is a commercial benefit. Bloomberg's are $24,000 a year per terminal. A Perplexity Pro license, if you need the Pro license, I don't necessarily think you do, and we're going to talk about that, is $20 a month.
Yeah.
So, convert it into pounds. It is such a massive saving. The ability to access information and run calculations is just unlike anything I've seen in the finance sector, and we wanted to talk about it.
Yeah, and you guys are in good luck because you got two AI nerds talking about it. Luke and I, we always go sort of back and forth with the latest thing that we found, and oh mate, look, I tried this out and this is what I got. But now we're taking everything we've learned from our sort of obsession with AI and mixing it with what we know about trading and having this cumulative knowledge and sharing it with you guys.
Yeah, exactly. And we didn't use AI to get dressed the same as each other.
No, that's just our chemistry. We're in sync.
That's just a total accident. So how are we going to frame this conversation? We're going to start by talking about the tools, right? So I'm going to give you two tools that are free to access, and you can look at it now. We're just going to explain the differences on why I would use one versus the other and what the benefits are. Then we're going to talk about actually how you can use it. And then we're going to talk about how hedge funds use it. And so what we know about the institutional market, money managers, funds, pensions, how they're using it and what kind of results they're getting. But to frame that, the reason why we're having this conversation today is I met a client the other day. In fact, I was talking to a client who listened to the pod on stops, the one that we did last, the first Moron podcast.
First Moron Trading Show.
First Moron Trading Show.
Something good came out of it.
We did a session on stops, and obviously we talked about using the average true range as a way to set a stop loss. My client took that. He was already using a coding base. So he used, as a bit of a mechanical trader, he was using ChatGPT to help him write code, to then backtest the strategy, run it through TradingView, which we have access to on their Pine script, introduce the average true range, and it improved his backtesting performance. And so day one, something that we did on the pod helped. But the interesting thing there was using ChatGPT.
Yeah.
And I just thought, wow, one, I'm glad that we've had a bit of impact, fantastic. But two, how easy or how accessible has the ability to backtest and write coding systems become at the blink of an eye. So we're going to talk about two models. What models are we going to talk about?
We're going to talk about my favorite French farmer, Claude, also known as Anthropic, which is the company behind it. But then the one you and I have a particular weak spot for is Perplexity. We are big Perplexity fanboys, and what we believe, or I believe at least, is the best search engine out there.
Yeah.
And we're going to sort of look at how we can combine these two. I think that's something that a lot of people are, starting to realize. We realize that just using one is often not sufficient. You can use one for one purpose and then another for another purpose. And that's what we're going to discuss, how we can combine Claude and its functions, and then getting the most out of that with Perplexity and the finance offering that they have.
Yeah. Okay, so let's start with Perplexity then. So for someone that maybe has a basic understanding of what ChatGPT does, you can ask it questions, it gives you answers. What does Perplexity do?
So Perplexity works more as in terms of a search engine. I call it the Google killer. The way they started off with just searching for basic information, and then you got your sources, and that was their sort of edge. But they've now sort of leveled up completely by integrating sort of Yahoo Finance, quarter financials, and all these live financial data. So you have this massive database, and then you search for whatever you need, and then it will give you the information lined up, and you can also sort of create programs with it. So for example, they have a live earnings call feature. So you can ask questions about the live earnings call that's going on and ask it to interpret it for you.
In real time.
In real time.
And you're never going to get that anywhere else.
No.
Well, you will eventually as this becomes more of a common practice. But it's taking earnings calls, it's taking the data that comes through, currently specifically just for US stocks, it's worth noting.
Yeah.
Hopefully it grows. And it's taking out all of the key insights. So for example, last week when NVIDIA came out, I sent a text over to all the people that I look after to say, you're going to get the exact data. So as the market moves, you're seeing in real time what Jensen was saying and why it was moving like that.
Yeah.
It's quite incredible.
Yeah, it's sort of like your middleman to interpreting the market.
Yeah.
So Perplexity to search and find and get sort of models. And then we're using Claude, the French farmer, with his... So I call it French farmer because that's what our French colleague Maxime on the desk calls it. Claude. So it's a great program. Don't know why they named it after a French farmer. But so we use Claude for the deep research, the reasoning, finding the nuance and hidden insights. Combining those two, magic.
Claude's become one of the best coding bases as well.
Yeah, it is.
It's become really quite impressive. So if you think about Perplexity as live data, okay, so Perplexity is where you start to break into this search engine world. This is where I think it's going to have an edge on the Bloomberg terminals that only institutions have access to, supposedly, or someone that's got a lot of money to put to it. Now you're getting, I would say, tough to put a percentage base on it, but let's just say you could do 60 to 70% of what you want to do on a Bloomberg. You're now being able to do that on Perplexity.
Yeah.
Then you look at Claude. Reasoning, calculations, all these things sound like fancy words. Basically, if you feed something to Claude, like your trading history or your positions, you can then ask it questions. So I use it a lot for taking in research notes. We then dump it into Claude and I say, simplify this. Or I will say, tell me, it can ask me questions about it. So say, right, I've read this, now quiz me on it. So it helps you with education and learning.
Yeah.
What it's really interesting to do is it also can now take in screenshots. So let's say you've got a trade setup, right? You've got a limit, a stop, and everything. You've got it set up. You can dump it into Claude and say, is this optimized based on X, Y, Z? So we'll come into that. But basically, you've got the two differences: Perplexity for live data, Claude as your researcher.
Yeah,
they're the two main differences. So they complement each other quite nicely. So this is where we can talk about how do you use it, right?
That's the
yeah. Where does it change everything? How about, and let me just pose a question to you.
Yeah, hit me.
What if you had an Axel sat on your shoulder at all times telling you why are you doing that, justifying it, challenging your reasoning, trying to push you, was your risk manager, and it was entirely personalized to you?
That's the thing. That's the purpose of it. And I think to get that sort of like mini Axel on your shoulder, you have to learn how to prompt it correctly. So these sort of, when we had the sort of salesperson from Claude coming in and presenting Claude for us, they presented it as an eager intern, willing to learn, happy to please. But it's important to keep in mind that how you prompt it is important. It's just as important as how you prompt it in order to get the output that you want. So it's important that you sort of ask you to be critical, think about it, and give the sort of input that you want. So you say like, this is my stop, this is my limit, analyze this out of a risk perspective. Otherwise, you might have the odd opportunity where it comes off and gives you what they think you want to hear.
Yeah.
So that's why you sort of have to be challenging that. So how do you sort of get around that? Because I know you've had some issues with the AI just telling you what you want to hear.
You got to be careful.
Yeah.
I mean, this isn't going to be perfect, but that's where I think where you feed it something as opposed to asking you to go and fetch something with Claude. I'd be much happier trusting Perplexity to go and do my research for me. And I'll give an example. We were on the show live the other day, and I think it was the news around Trump was talking about lifting sanctions on Iran, specifically Iranian oil.
Yeah.
And in real time, and I typed into Perplexity, and you can go back and look at the recording, what is maximum capacity for Iranian oil production? And where has it been over the past 10 years? And within seconds, I had a chart showing all of the different values of millions of barrels of oil per day and its maximum capacity. And you can see how much capacity Iran had to uplift the market. And we were comparing it to why the oil price was down 3%. So you could say, right, is the oversupply that it brings you, does that make sense? Yes, no, maybe, and then you can place a trade off the back of it. But you're not getting access to that research anywhere else.
No. Contrast trying to find that information just by Googling it.
Yeah, it's nigh on impossible.
No.
Nigh on impossible. But I think to start with, you've got to treat, or you could treat this as your co-pilot when it comes to trading, right? I know Copilot is the Microsoft branded AI, but just ignore that for a second. At the end of every day, if you downloaded your history and you put it into a Claude project, you can then ask it questions. Did I move my stops at the right time? Should I be putting more stops on this? Have I got any on at all? Can you optimize this for me based on criteria ABC? Did I enter at the right time? Did I exit at the wrong time? And you can start to quiz your history. And of course, as you add day to day to day, your trading history, you've got a coach that is going to continue to give you insights. I mean, for example, you could say, right, I've closed 3 trades today. 2 were winners, 1 was at a loss. Why did the one close at a loss?
Yeah.
If my stop was too close, and you can search this, what if I moved my stop lower by 1%, 2%, what would have happened? You can play scenarios on it. Let's say you had a portfolio of stocks. You're a single stock equity guy, your ISA, your SIP, whatever it might be. You dump your portfolio in, and I had a conversation with a client yesterday, face to face. This particular chap had a UK tilted equities portfolio. We can dump that into Claude and just say, analyze my portfolio. All of a sudden, you're going to get real-time insights on, okay, you're allocated into the healthcare sector, you're allocated into, it might be defensives, it could say you actually haven't got any tech exposure, and actually you're going to underperform the index as a result. And then you query it, okay, give me the top performing UK-based tech plays, build me the watch list, and in fact, I want to optimize that based on stocks that are near 52-week lows, where analyst ratings are the furthest away, and I want to look at putting them on now. Give me the watch list.
Yeah, and I think something key that you mentioned is creating a project, right? So it's oftentimes that you sort of feel it's a bit repetitive with your prompting. You have to give all the information all the time. If you create a project within Claude, ChatGPT, or Perplexity, you have a sort of knowledge base, and then you can give the AI the instructions that you want it to operate from every time. So yeah, it'll take a bit of time the first time. But what I do when I create a project is I first sort of just write out in Claude, hey, I'm creating a project. I want to create a project. I need your help to finalize and fine tune the project instructions. I want it to achieve, the purpose of this will be to analyze my portfolio, my stop losses, risk management, and I always want you to have X, Y, and Z in perspective when giving me a decision. It will then write you a prompt in order, it will give you an output that is optimized for the project to understand, and then you copy and paste that into it. So every time you ask a question, it will always have that sort of knowledge in the back of its head. That just makes your whole process much, much faster and efficient.
Yeah, completely. And you can use it. So, from this trading co-pilot perspective, you can be your coach, but when we talk about this portfolio optimization, you can also run simulations.
Yeah.
What happens if I was running this portfolio in 2008? What happens if I was running this portfolio again during Liberation Day, and it will know exactly what markets moved, how they moved, what stocks, sectors, FX pairs, whatever it might be, and then get it to stress test it for you. So these are all things that we're talking about via Claude. And again, make the distinction. Claude, we feed it something so that it understands what you're giving it. Perplexity, we're searching for things. That's one of the big differences. You know, you could give another scenario, the one that I quite like. I've got a 10K account. I want to take 2% risk. You know, we go back to the episode where we start to talk about the maths on this.
Yeah.
I want to take 2% risk in these 3 sectors, plan my risk management strategy, and it will give you these questions. It'll probably come back to you and ask you more questions. What's your holding period? Do you want to hold any risk overnight? Would you like to hold risk over the weekend? And you can keep talking to it, and it will keep giving you tips. And it's just it's quite incredible.
Yeah, that's something I always add to my project instructions. You sort of tell the LLM, always be critical, always ask clarifying questions. That way you fine tune it, because you don't want a yes man LLM. You want someone who actually gives you insights. But yeah, I was actually looking at, so I had a client who called in the other day, and he was saying that, I think that we're going into a recession, American recession, etc. What sort of stocks perform well in a recession? I prompted Perplexity saying, which stocks performed best during the 2008 financial crisis? It gives you a complete and total breakdown. And then you ask, okay, which stocks are have the similar characteristics of today in the S&P 500 or the US tech, or even in the FTSE? So I think that's what it's really to be used for, giving you that information and then pushing it into Claude.
Yeah, I mean, let's use a more recent example. So there's a Perplexity. For those that trade on a desktop, there's a Perplexity Chrome extension. So you can just click on that, and it will give you a little prompt box. So you don't even have to go to the Perplexity website. And you could say, right, I like the story that broke last week where Trump was going to talk to lifting the restrictions on nuclear energy. Okay, I remember having a conversation with a client. What stocks should I look at? Yeah. Type it in. What stocks could benefit in the US if nuclear energy is lifted? Give me 10 stocks. Come straight through. You're getting Oklo, you're getting Nano Nuclear, you're getting Constellation Energy, all these names that come up. And these may be names you've never heard of before, but now you've got the basis to take those names and do more research.
Exactly. It doesn't tell you exactly, you don't want an LLM to tell you, do this, do that, right? You want to have your own reasoning and everything applied still, but it gives you that sort of starting point, right? You don't start with a blank page. It gives you that first, word on the paper, and then you take that information and you have the basis to build upon it. Yeah. But yeah, I mean, as always, you need to sort of build your own understanding. It will give you an objective description and analysis. Then you, of course, as a trader, as an investor, have to look into and see, okay, which one of these fit my risk appetite, fit my analysis best. But what it does, it sort of cuts the time process for you to make that research and find those by 95%.
Yeah, and I guarantee that everybody listening to this will have questions about the stocks that they own, about the sectors they're invested in. Another conversation I had with a client yesterday who's got several investments in oil and gas businesses. So UK listed oil and gas businesses. Clearly they look at the North Sea. The North Sea has been kind of slowly, been beaten up and spat out, no money being spent on it. You could be a hedge fund analyst and you could spend time traveling to kind of Aberdeen in the North Coast. You could go and talk to all of the operators to find out, what are the maturities of the wells, how much capacity is left, what are the runtime, what is the cost of a barrel of oil to pull out over there, what is the lead time on getting things delivered. Or you could type it into Perplexity, all of those questions, and they said that they built a map effectively with all of the different oil locations, all of the different drill locations, and it graphically gave kind of almost like a tank of oil, kind of how full or empty is that particular well. It's insane.
That's insane.
It's insane. And you can get all this research, and you've got to be slightly inspired by, questions you're having, conversations you're seeing. Maybe you've read a news article on our platform about the nuclear energy or about oil, and you can sit it in there and you can have a look and you can do this research. It's quite incredible. There is something to be noted on. You've mentioned the prompts already, and that's really important. So getting your prompt right is really important. So a simple one: should I buy Tesla? Good prompt, bad prompt.
horrendous.
Why?
Because it's too broad, right? You're not specifying anything. Should I buy Tesla? Are you buying Tesla for a long-term investment? Are you buying Tesla for an intraday trade? You're not giving it enough information to give you the answer you're looking for. If you just say, should I buy Tesla? It'll give you, Tesla is a robotics and electric vehicle company, blah, 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 and it'll give you all that information, but it won't give you anything actual concrete that you can use then as an actionable insight. That's what I think.
So how would you generate a prompt?
Okay. So
what do we think? Tesla's the kind of the long run Tesla is the story around robotics, the story around energy, the story around the AI story. Okay.
Yeah.
So what do you need to know, looking at Tesla's price today, wherever it might be? What do you need to know as an investor, or what would you like to know?
So here's the difference. If I'm looking at this as an investor, or if I'm looking at this as a trader, my prompt will be quite different. So if I'll be looking at Tesla as a trader, I would say look at the 52-week range of Tesla, see what the analyst expectations are for short-term, medium-term, and long-term. I'd also ask to see the sort of volume, market movement, and I would ask it to take all this information. So I'll say, I would list the sort of 5 things that I wanted to give me insight on, and then I'll say, take all of that, give me all of that information, and make the judgment if Tesla is a buy, hold, or sell. And then from there, I would take that, I would have that sort of information given, I'll dash it into Claude, and then I'll do a thorough analysis, and then I'll ask it for entry points, exit points, and to have that sort of completely set up for me. And then if I would look at it as an investor, I would say I'm looking for a long-term play in Tesla. I believe that Tesla is going to do well due to the robotics and the AI and the self-driving cars. Can you analyze the competitors in the segment? Can you let me know how Tesla is predicting that the cash flow and the benefit of the stock will be? And then give me that insight to tell me if Tesla is a good or a bad long-term play.
Nice and simple then.
Yeah, nice and simple, nice and simple. Yeah, just straight to the point.
I'd look at it a little differently. I mean, I want to know what part of that share price is currently being assigned to this robotics growth. So
that's what everyone's talking about,
yeah. I'd say, given the share price currently and what we know about Tesla's earnings and forecasts of its share price, how much of that is currently being allocated to this growth story? What are the assumptions that it's being made now? What are the risks to the robotics story? What am I missing? And what does it look like in 1 year, 5 years, 10 years? And you start to think about these things. And of course, as you build up this conversation with a Perplexity, it's going to be pulling in more and more information. And what Perplexity does really, really well is using recent news or using recent searches from everybody that's using it. It gives you suggested follow-up questions.
Yeah.
So it's as if your plucky analyst person that sat next to you is super proactive. So it's like, oh, hey, I get you've given this search and here's this output, but you didn't ask this.
Yeah. And it's like, you asked this, you might be interested in this as well.
Yeah, completely. It's incredibly powerful when the fact that this tech is now at your fingertips. It's brilliant. You could also talk about specific news on the day. So if you go to perplexity.ai/finance, it gives you the real market prices for all of the US indices. It gives you the stories of what's going on. So you could ask it really cleanly, I want to be prepared for my morning trades. It knows what you trade because we assume you're using this as a trading journal and you're dumping your history into there. It's going to know exactly what you need to know in order to prepare you for your day.
I'm now actually prompting Claude to give me a Tesla.
Is that what you were doing?
Yeah.
I did wonder what you were doing there. Look, how do hedge funds use this right now? Kind of what evidence do we have?
ceasefire is holding. It's Tuesday, June 24th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Elias Spivak in San Francisco, Jamal Chandler in studio from Chicago, taking you through the rest of this hour. Market closes at 5 Eastern, 4 Central. If you're on the platform on tastylive.com, thank you for joining us. Welcome. Come over to YouTube. Tell us what you're trading, what you think of this continued collapse in oil prices, down another 5% today, as an Iran-Israel ceasefire is announced by President Trump yesterday after hours. You heard that here first, though, of course. The market here continues to move up, with the NASDAQ pushing to fresh highs that we've seen since late February. Same for the S&P 500. Ultimately, gold's down by around 2%. You see the dollar pull off a bit. The headlines weren't fantastic today, guys, but it's a low volume, low volatility type of session as we turn to the charts, with our NASDAQ up at 22,400 or so here after hours. It's a small little dip from where we closed at 4 p.m. Eastern. But nonetheless, Jamal, you're new to the show. Welcome back. You've been gone for the past 2 weeks, so we'll give you more talking time here. What do you make of this after all that's transpired the last 2 trading sessions?
I make of it... Well, I mean, is Trump really getting nominated for like the Nobel Peace Prize for? I mean, that's what I saw. I don't know what to believe anymore. I don't know. I see a lot of things these days, guys. I don't know what to think. I really do believe that regardless of whatever the news was, the technicals were telling us that we were going to be higher at some point or another, and they came through and they showed through, and they showed up in the form of NASDAQ, which is something I've been long for a little bit. As much as I didn't want to believe it, and Chris, we talked about this a month and change ago as this was forming in the chart. I didn't necessarily believe things were going higher based on what was happening currently at that time, but the chart showed that there was a really good chance we could be at all-time highs come the end of the quarter, and sure enough, that's exactly where we are. So, there's a lot of other news. There's a lot of things mixed in here. You could throw in tariffs. You could throw in Iran, Israel. You could throw in the Fed, but fact remains is that we're a stone's throw away from all-time highs, if not kind of having touched it a little bit in the NASDAQ today.
Ilya, we're not quite at all-time highs yet, but we're getting pretty darn close. Surely that provokes a change in your posture.
It certainly does. I mean, my thinking here was we had a high on all of the indexes basically on CPI day 2 weeks ago. And nothing wanted to go anywhere, not on the FOMC, not apparently even on the breakout of a war in the Middle East before all of this seems to have now started to unwind. And so the market looked weak because it had no conviction in taking any kind of notice of anything. So when you look today and you see that we're closing above that high, well, that's all you need to see as far as I'm concerned to say, I don't have the trade I had before. This is inherently a different trade now. I'm certainly not bullish as we approach the highs here because I don't think anything has changed for the better relative to where we started the sell-off in mid-February, but we're basically back to that starting line. We've done a full round trip here on the S&P almost. And just the act of closing above this swing high is enough for me to take my little baby put verticals here and go home. So I've unwound that exposure. I've not flipped it over. It's not great that the dollar is down today because I flipped over that exposure on Friday from short to long. It hasn't crossed any Rubicons so far today. So we'll see if that one unclenches. But very interesting that the markets on this low volume day didn't seem to want to panic on the war, but do seem to want to rally on its apparent unwinding, which is a little bit incongruous. But I guess you can't keep I won't say a good market down, but you can't make an aloft market down.
It's a good market.
Who's more bearish? Who's more bearish? You or Tim Knight?
Well, that's a good question. I'm probably as bearish in my kind of disposition broadly, but I'm probably less bearish, certainly not bearish at all at this point in terms of my execution. In fact, since I've unwound these shorts, I'm actually net long equities at this point.
I mean, my next question was going to be, why does this bearish mostly reside in the western portion of the United States? Does it sit on a fault line or something? I mean, what is the deal?
So with you and Tim, we have ticks over here. They don't.
You might say this is the kind of contrarian thinking that eventually breeds a revolution, but eventually is the key word.
I don't know where to go with that. Volatility here is probably the most interesting aspect of all this. Back 2 weeks ago, the reference point was June 4th. You were looking at a VIX term structure where the front month, back month spread was roughly speaking 6 points or so. Last week on the 18th, when we were discussing this on air, it had shrunk to about 3 points, actually a little bit underneath that. Today, by the time we close out the session, you can see how normalcy is returning. Jamal, we're back to 5 and change. Is that all we really need to know here? VIX in contango, volumes low, technical drift high, summer here, end of quarter chase?
It's an interesting thing because like you said, we're in contango. I mean, just forget the numbers on the chart. Just look at the curve, right? We're in contango. And normally we'd be like, yeah, that's what I would expect when, we just had this huge day and we're basically near all-time highs and we're in contango. Where it gets interesting is the fact that you do have to pay attention to the numbers. And the fact remains is that this whole curve is upwards of 19 to 20, right? And that means something for those of us who trade. I mean, when you see big numbers in that range, it means things are a little bit elevated, but you can't ignore the fact that we're in contango. And really what it says to me is that the whole curve is a little bit higher because of the current, not even current, I shouldn't even say current. It's just the environment that we're in. The inputs to this environment say that things are going to move around a little bit more than what we've used to seeing over years in the past. That's what I read when I see this, when I see that we're having a VIX, at these levels, 17 and change. And again, it just came in a good bit today. But typically after a big 2-day rally like this and all risk is off, it would feel like VIX would probably be around 1549 as opposed to 1749. And I just think that it just means the whole volatility curve is a little bit more elevated because in the inputs to this incur environment say in 2 weeks, there could be some other risk situation that happens that we're not prepared for that pushes VIX back up to 1920. So I think we're just going to see a situation where we're moving more than 1+% on any given day in the stock market because that's what VIX is telling us.
We're at 17.49 here on the VIX. We're approaching the cycle lows that we've been at post-Liberation Day, if we want to consider that a separate cycle. Even in the VIX front month futures here, Jamal, you and I were talking about this on Futures Power Hour, so I suppose we can round this out and call it ultimately something that did come true. We have a VIX that's at 19.25 here, which is now the lowest close post-Liberation Day. Ilya, I know I have a feeling of what you're going to say, but then again, you're not executing on this idea. Are we complacent in the market right now?
I think there is definitely a sense of complacency here if you look at what was the not Iran news today. And that, of course, was a testimony from Fed Chair Powell, who gave us a very familiar song and dance. Mm-hmm. Came out and said, listen, we don't know. And we think that there's going to be a way that we're going to know when we know. But for now, the impacts of the tariffs are delayed. All major forecasters, including the Fed itself, are expecting significantly more inflation. From the tariffs. They think they can make it a one-off, but they don't know what it's going to look like. They're concerned that it might spill over into inflation expectations, so they're not in any kind of a hurry to cut until they actually see it happen. And it's a very familiar argument. Powell was saying, look, inflation is only a touch above 2% now. The unemployment rate is historically low at just a touch above 4%. Why would we want to front run this until we know what it is? We're just going to sit back and wait. We're in the middle of a 90-day pause on the full implementation of this thing. That means its onboarding into the economy is going to be very extrapolated. So let's see. And the markets, they plainly do not agree. Because if you look at what Fed funds futures are telling you, the 2026 outlook for rates became more dovish after last week's Fed announcement, even though the Fed itself became less dovish. They dropped a rate cut from the outlook for next year. The markets added one. We're looking at break-even rates that are now falling again with oil receding after the Iran shock. They've been pinned to a low range since April, whereas stocks rebounded from the growth scare around the tariffs. Break-even rates never did. And so you're seeing the bond market telling the Fed, you're wrong. We're a lot more concerned with some kind of economic downturn than we are with any kind of an inflation shock. You should be cutting. And very clearly, the Fed is resisting. This is very much like last year. And last year, this produced a spook for stock markets, but more importantly, it juiced up bonds. It weighed on the dollar until we got into the Fed's actual cut when they went so big that it threw the markets in the opposite direction. But I think if the markets are screaming at you, we're concerned about growth, and the only economy growing in the global pie with any kind of consequence is the US, whereas Europe and China are stuck in the mud, you can't afford to lose that US growth lest you have a global recession, yet stocks are at within a hair, let's say, of the highs of the year. It smells like complacency to me.
It could be complacent, Jamal. Do you feel like it's complacent at these levels? Do you feel any different than you did earlier today?
No, not really. I do wonder, though. I mean, I agree with you. It is screaming that maybe we're like kind of possibly slowing growth. But like, do we need to cut? Do you feel like we need to cut? I mean, I know we're obviously you're looking at December, which is great when you were looking at the SR3 contract, and it's showing you 3.75. It's showing you the idea of two cuts. But do we need to cut? And if so, what is flashing that we need to cut? Obviously that's showing that we're possibly going to cut, but what is flashing that we need to cut? I'm actually like dead serious.
Falling inflation expectations. Because when inflation expectations fall, real interest rates surge. Interest rates are, and that's sort of the real cost of money in the economy. This has been the Fed's argument for rate cuts for going 2 years now, that essentially they've taken down inflation. That's pulled down inflation expectations. If rates, nominal rates, don't then come down, the nominal rates minus that now lower expected inflation gives you higher real cost of money, which crushes the economy. So the idea is you need to have a pacing down of nominal rates to match what inflation expectations have already done. And at baseline, you need to get to, in the best of all worlds, some kind of a foundation for a soft landing, and that's how you would do it, or the economy would hit a wall. Now, that doesn't mean that there's an economic downturn. That's sort of the Fed's rationale for we need to normalize rates from our fight with inflation. No economic downturn. This is just a maintenance thing that we have to do. And the markets have been okay with that, clearly. The larger issue is if they need to do something for growth. And again, these 5-year break-evens are suggesting that they do. But we'll see if and when, as it were.
That's the thing.
You mentioned if the Fed should be cutting rates right now. It's an interesting question. There is a way to try to take a crack at this through an objective manner, mathematically. On the Atlanta Fed's website, they have the Taylor rule utility function, which is basically prescribing a Fed funds rate based on a few different inputs, GDP, inflation. And ultimately right now, when you talk about where that ends up, if we're thinking about a 2% target anchoring point, then the Fed funds rate probably could be higher. If we're looking at other models, maybe it could be a touch lower, but really on the low end, you're talking about 1 or 2 cuts if the current range is 4.25 to 4.5. So maybe 3 cuts on the high end, down to 3.5 to 3.75. But you're not exactly talking about Fed policy that's significantly out of whack. Like another cut or two by the end of the year, all things considered, policy would be in line with some of these neutral, objective mathematical equations to suggest where Fed policy should reside. If we didn't have the tariff overhang, though, as Powell said today, would we have cut rates by now? Probably. And I actually think that's the most important takeaway of what Powell said today was they see that the inflation, because of inventory cycles, will make its way through the economy in June, July, August, which it's June 24th, given the calendar we have in front of us. That realistically means that there's no Fed cut in July because they're waiting for that data, and then they can cut in September. So the Fed is a done deal for me in the short term. I actually think it's a really uninteresting conversation right now. I'm disinterested in talking about the Fed, despite being someone who cares so much about it, because Powell's telling us either stop the tariffs or we just got to wait and see.
Right.
And we could take issue with the data dependency versus the narrative that he's trying to construct, right? Waiting for narrative to play out. It's not happening. Nothing's changing. So I think, Ilya, we talk, big picture, maintenance cuts, recession cuts, emergency cuts. We're not getting a maintenance cut anytime soon before September, by definition, for what Powell's told us. So the only paths forward in which we realize a potential rate cut would be emergency or recession conditions at the July meeting. And that's not a good outcome for stocks. So as a bull right now, I don't want cuts. I don't care about cuts. Not until July 31st, Jamal, when our expiries sit for those NASDAQ calls. The cuts can come afterwards. But really, realistically, like this is kind of where you want the Fed, sidelined in a corner. Trump's taking heat, giving them heat. I personally don't think that's a big deal, but it's low volume, low volatility, positive technical drift, summer months, and there's a lot of bricks in the wall of worry right now. Ilya, what was your big takeaway from Powell today? I know you just talked about him briefly, but is there anything, did you have that one clear idea like I did about don't worry about the Fed until September?
I mean, I think we've known not to worry about the Fed until September for a few days now. And we've been talking about how, just like last year, this is almost a full rerun. The Fed becomes a creature of the calendar, and then you know what's going to happen. So they're
going to cut Fed 50 in September again, aren't they?
Yeah, the Fed has September. Last year it was early November. This year it's late October and December. Right? If we know the Fed's not going in July, there is no meeting in August. There's Jackson Hole in August where they retune the lens and set the stage. So in September, they either cut or not, and then they have 2 more meetings, and they have 50 basis points on the calendar now. So if the next time they do anything of substance is September, then you only have but so much time to do those 50 basis points. You're updating the SEP in September. So you're in a situation here where the 50 basis points are not really an object of speculative interest. It's pretty much a done deal. There's not really time for much of anything else, unless you scrap them suddenly. So
or you cut 50 in September and give 25 in December.
Or you do that. But if you update the SEP accordingly. But between now and September, there's all kinds of time where nothing substantive is going to happen. So this year, as far as sort of Fed opportunities to do things, unless they have an emergency meeting or something. So you have now very little room in that 2025 forecast. It's basically a done deal. But next year, it's a big, big difference. And so this is where I think speculative interest is. It's where it was all through the summer last year. It's what drove the moves last year. So I think when you look at what Powell said in particular about when the impact is expected to come, he said, we would expect to see meaningful tariff inflation effects in June, July, and August. Could he be any more transparent? In other words, by September, they'll make a call. But in the meantime, It's, do the markets believe what the Fed is selling? And the markets are saying they don't. That disparity is going to have to close. That's I think the most interesting thing here, that the Fed is basically saying we don't know, and the market's saying, but we do. And
the markets say we do.
And we don't agree.
Okay, but I'm trying to. I'm putting together the calendar here in my head right now, and maybe this would be an exercise. We need Mike's whiteboard, Jamal. Okay, so we have July 9th for the tariffs.
Yeah.
Okay, we have July 30th for the Fed. Are we all in agreement here that July 9th, if you let those tariffs lapse, then China has lower tariff rates than a lot of countries? That's not what the administration wants. So we'll assume July 9th gets kicked out. We have July 30th for the Fed. Fed's not going to cut. August 12th for Chinese tariffs. That one, I think, is the live issue we need to worry about over the summer. And that kind of comports with what happens during the summer. It feels like every year recently.
August.
Where something happens in August, right? In the second half of August, September's rocky, market bottom sometime in October. You rip November and December. Feels like clockwork. The main reason, in my opinion, and I'm not the only one with this opinion, and it's not a unique thought, but having read everyone's opinions on the issue, I've landed in this camp. Part of the reason why Trump pushed back the tariffs with China is because of the toy holiday season in the winter. Jamal, you and I spoke about this on Futures Power Hour, but inventory cycles for a lot of these goods are 6 months. And so if you put tariffs on in May, all of a sudden when parents are buying toys for their kids, you're not going to have 30 Barbies, you're going to have 2. It's not my line, that's the president's line, but that's because the inventories would be impacted in November. But if you put the tariffs back on and you ratchet back up the pressure in August, it's not going to disrupt peak consumption season here in the United States. And I think that's the window where all of a sudden you have Trump's tariffs going into play, a market that's getting ready and thinking about these potential rate cuts in September, and all of a sudden, okay, hold on, maybe we're not going to get those cuts because Trump is turning back on the tariff spigot. And that's going to give the Fed another excuse not to cut. And just that dynamic in the second half of August with a market that's seeing thin volumes and probably people mentally exhausted from what's been has this been a trying first half of the year? Apparently there's more gray in my beard. My daughter told me it looks like I'm dying. I think that maybe if we're going to be bullish here, we still have a window, Jamal. I think it's really difficult to get bared up even if you have a complacency point of view. But all-time highs look like they're wanted. We squeeze, we get a blow-off top in over the next 4 to 6 weeks, and then we can play a little bit more bearish for August, September.
I mean, look, July 9th is really not that far away at this point, right? We're already at 624.
2 weeks.
So honestly, I feel like we wouldn't be doing what we did today if the market was really worried about the July 9th coming. And this is one of those things, right, when we talk about volatility and why volatility happens and ratchets up. It's the uncertainty of it all. And I would say now that even if that timeline lapses and there isn't another pushback and we hear it all over again, I don't think it's going to be that easy to telegraph and see we're going to be down to 4,800 again. I just don't think it happens that way. It's not to say we don't pull back in some form or fashion, but it's not going to happen in the same way that you thought it was. We've been trading too long to know that just doesn't occur that way. I wish it did, but it does not. But I would say, the market doesn't seem to be too worried about that. Your point about August is well taken. And again, it could be something we're not even aware of yet, right? That ends up creating that situation, whether it's August or September. I mean, last year we got both. But I say all this to say I'm starting to feel, after today, I'm not as worried about the prospect of July 9th and whether we actually get those tariffs in place or things change. Now, again, maybe in August, maybe it's the Chinese tariffs, maybe it's something different. But for now, look, markets made a clear signal over these last couple of days. And the charts showed it too. We were basically in sideways consolidation for a couple of weeks there. And then boom, we broke out higher. Could have easily broke out lower, but we broke out higher. And it feels like markets are going to start to drift a little bit higher until we do get the next thing, which could be July 9th. But I just don't think it's going to lead to the carnage that we saw earlier this year, which was wild, which created a nice double bottom, which was, I mean, dude, it's amazing how it ends up happening. Like a nice double bottom, nice little formulating handle at the end, and then boom, we break out higher. I mean, this is exactly what you want if you are looking at its chart technically to work. Whether you want it to happen or not, this is what you want to see. This is efficient markets.
It's certainly very clean technically. There's no question.
Ilya, one idea, I kicked this out to Nick Batista earlier this morning over chat. If we look at previous episodes where the United States is engaged in limited military action, constitutionality aside, let's talk about, I know people think it's unconstitutional. I think it's constitutional. Article 2 defines the president's war powers pretty clearly. When we look at how the markets have responded to other episodes, it's usually stocks up, bonds down when the market perceives it to be a limited set of action. The threat has been lifted, so there's no reason to hold on to safe assets. Dollar's down a little bit today. Gold is off big. Stocks are up. That all kind of comports. But bonds are rallying.
Yeah.
That can't... Okay, so we've been pitched this story for a number of years. You've been a notable person who's kind of thumbed your nose at it, that the BRICS are coming to replace the US dollar, and that there's an alternative system out there that can rival the US-led Western financial system and ultimately US-led trade system. People think, why do we have so many ships at sea? We're just projecting our empire. It's really to protect commerce. It's really to make sure the shipping lanes are secured. Okay, so Iran is part of that axis, that nexus of countries that are part of the BRICS network. China and Russia, obviously the military might, China being the economic might, India perhaps rising as an Indian military might, but Iran is supposed to be part of the military wing. They have Iranian, or they have Russian technology, weapons platforms. They do have some American stuff, the F-14 Tomcat, which is really interesting if you read the history about why they have that plane in particular. Nevertheless, the point is that Iran, which is supposed to be like the barking dog that does Russia's bidding effectively through the Middle East, was just defanged very quickly. Russia can't push Ukraine out of its own backyard. And so all of a sudden, a Western-led system, what alternative is really coming up? What might does it have?
Alternative.
Well, we know that.
Alternative.
But can we contextualize that in, say, the tariff negotiations? Because it feels like some of the signaling from the rest of the world throughout all this has been, well, we'll just all work together and we'll go to China and we'll work with the, the independent countries and the BRICS and we'll hammer out deals. And Europe is turning to China, right? Are they going to let BYD into their markets?
Mm-hmm.
Come out to
doesn't
the
this kind of
get together? We're having a few laughs.
But doesn't this reframe these negotiations with the U.S.? The U.S. still has the ability to project strength, and the alternatives out there, they're kind of flimsy paper tigers at best.
So these are not the same idea necessarily. So there's two separate things here. Number one, this off-ramp with China that we just had after we went to basically an embargo was pushed from the U.S. side because U.S. auto manufacturers really, really, really needed the smelting and processing of rare earths into all of the various things that automakers need.
We need the magnets.
And we did not have a backup. So, and China was basically digging in. Now, is there a legitimate alternative to the US dollar as the global currency of commerce? Not even close. Is there a legitimate alternative to the US Treasury bond as the benchmark risk-free asset for global commerce? Not even close. Is the US at risk of default? Not even close. Not even remotely. Not even kind of. Does that mean we're still on a unsustainable fiscal trajectory? Sure, yes. Have been for a while. It's gotten worse. It'll probably get worse before it gets better if this big, beautiful bill thing passes. It's very deficit expanding. But those things and the tariff negotiations are not quite the same thing. I think what we just saw with China is they were willing to wait us out despite the fact that we're the world's largest consumer market and by far their biggest customer. They can't replace us or anything like it. Also, they were getting ready to dump all kinds of excess capacity on global markets, which nobody wanted. But that was a very significant disinflationary or even deflationary risk. Europe was worried about it. Australia was worried about it. Japan and Korea were worried about it, on and on and on and on. But we've managed to walk it back, and it's at our insistence, not China's, because we basically had to yell uncle, having overshot on exactly what kind of a tariff regime we actually want. The European Union came out just today and said, if you think we're the UK on this baseline 10% tariff, let us disabuse you of that notion right now. That's not what we're doing. So it's one thing to say that the dollar isn't getting replaced, the U.S. Treasury isn't getting replaced, the U.S.-based economic order isn't getting replaced. That's just, the idea that there is a viable alternative is just nonsense. But at the same time, our trading partners do have leverage. And that does not make for smooth negotiations going forward.
Looking at this rally here, guys, looking at the top performers as we make our way, well, we're a little bit more past the halfway mark here of overtime. Semiconductors, Jamal, just like on Futures Power Hour, they ultimately do finish the day higher. This is the highest close that we've seen going back to last July, for what it's worth, in this market. Pretty impressive, breaking the downtrend from the July and those February swing highs here. It's a consolidation that lasted a week and a half, but it's now a fresh 2025 print to the upside. Telecom, likewise, is performing well. I was scrolling through a few of those names here. This is a fresh closing high for the year. A name like Cisco pops up on my radar today, which is closing up at a fresh all-time high. The tech names overall were very, very strong. Technology now at a closing high for the year, breaching everything that we saw pre-Liberation Day and then some. And Ilya, we're breaking the highs that we had prior to that growth scare kicking in February, for what it's worth. I only know that because that was this candle, and Mom's birthday top ticked the market for the year, so can't forget that. Okay, I remember having dinner with her. She's like, "Oh, stocks are doing pretty well this year, Mom." I'm like, "Yeah, they're going to keep going up." they have kept going
dinner
up.
with your mom anytime soon, or
no, they're going to California this weekend, so no, not anytime soon. But you have the growthy stuff on top, right? You're looking at the
that's the indicator.
Banks.
That's
banks
the indicator
here.
right there.
Yeah, well, I was told last week that when Tom goes on vacation, something bad happens to the market, and consider my surprise when I saw the headlines that the U.S. bombed Iran.
Yeah, we can debunk that theory now. It's over. It's
So, but like everything growthy is kind of working here, and all the stuff on the downside is commodities related. It's energy, it's gold miners, it's materials, it's consumer staples, it's defensive names right now. Mm-hmm. Even on the broader basis, QQEW is up 1.71% today compared to the broader NASDAQ. We go to the triple Qs up 1.53%. RSP 0.97% higher. So not quite, we look at SPY, this is up 1.1%. But tech distribution is going on. Small caps are up 1.21%, a little bit better than their S&P 500 counterpart. Mm-hmm. Jamal, I feel like I'm not speaking to the fact that I think the economy is in great shape or that we're going to be getting a lot of monetary support. Money is being spent. The federal government's going to be spending a buttload of money. That's a macro term. And it's going to continue for the foreseeable future. So public sector surpluses, or deficits or private sector surpluses, that tends to be inflationary. People are offside still. Why wouldn't this market just squeeze now for the next 7 days into the end of the quarter?
I don't see why I wouldn't. Honestly, I mean, people are out of dollars and they seem to be into the stock market right now. The one thing I will say, I do look at the S&P 500 names above the 50-day moving average, like we have on the platform, that $SPXA50R. And right about now, it's 76%. Usually when we get around 70+%, 80%, we see a little bit of a pullback. Does that little bit of a pullback happen in the coming days, and then we'd get the end of the month rally, and then that heads into the beginning of July? Or do we rally into the end of the week and then, or even the end of the month and then beginning of July get a little rollover? Because I think we had that last year, if I'm not correct. I remember because I was pissed off and I traded it wrong. So, but I mean, it's one of the two, and I think maybe there could be Again, I'm saying pullbacks, not sell-off. I think, the idea of a sell-off is only really happening on some really bad news, really something bad with regard to tariffs or something else we're just not aware of yet, which could easily be manufactured in the stock market we're in. Again, that's why we're back to VIX. We have VIX of 17 and change and VIX futures over 19.20, because that's how it has happened this year. And I think that's how the market is still interpreting the potential chance for any random thing that we hadn't even thought of yet that could derail the rally. But, without at the risk of talking my book, yeah, I mean, I from what I'm seeing right now, there's still an area where, again, we're in contango. Even though it's a higher contango, it's still contango, and markets are just a stone's throw away from all-time highs. So it's something you alluded to earlier on Futures Power Hour, Chris. Please don't poke the bear and talk about taco trades, et cetera, because it could unravel all of everything at some point or another. But I don't see anything in the way right now of reaching all-time highs. I mean, again, I just think, sure, volume might end up drying up a little bit here as we head into the holiday, end of the quarter / holiday. But I don't think that's necessarily a bad thing for all-time highs. I think that ends up being good somehow.
Guys, we haven't touched on oil yet. I suppose that's the elephant in the room here. It's down another 5% today, driving much of this. I couldn't help but notice a very eye-raising headline today on MarketWatch. This just came across a few minutes ago. Why falling oil prices could actually drag down the stock market.
What?
Oh boy.
Mark Colbert, you need to...
Why can't we just have nice things? If oil's up, it's inflationary. If oil's down, it's recessionary. If interest rates up, it's wars are getting crowded out. If interest rates are down, savers are getting screwed. No one can be happy.
Look, if you break the bottom range on oil, it won't be the break of the bottom range on oil that's causing the recession fears. It'll be the recession fears that are causing the bottom break on the range in oil. So let's not get ahead of our skis here. What we've done is we had a geopolitical scare. We've round-tripped the whole thing, and we're back to where we started. If you put a horizontal line right where those April-May highs are, where are we? Back to the starting line. There's no growth scare here. We're in the middle of the range. Now we see. Show me a break back through that sort of axis level, and okay, let's talk about why. Let's see what is happening in context. Do you have a push higher in the bonds in context? Is there any kind of a shuffling in Fed funds futures forward in on the curve for when the cuts are coming? Is gold rallying? Okay, now we can start to piece together a cross-market narrative saying the market's getting concerned about growth, like in a more present tense kind of way. Now you look at the bond market, as we were saying before, and they're concerned about growth in a 5-year break-even rate kind of way. That's not this year. The Citigroup Economic Surprise Index is fading. The Atlanta Fed GDP now model is showing the most recent data is negative. You're seeing it, but it's not now. It's not, oh my God, concerns today. To say that the drop in oil, returning it back to where it started before the sort of geopolitics took it over, is some kind of a growth indicator is, to me, kind of odd.
Oil's the interesting play now because you said we've round tripped. We're back to this kind of dividing line in the sand right near 64 or 65, depending upon what contract you're looking at. Jamal, you and I were looking at some adjustments today on Futures Power Hour. I got out of my short deltas in crude. I also neutralized the original short iron condor position that was put on back towards the end of May, which by some miracle was able to get out with a profit. But thinking about the volatility in this market here, it's continuing to come off. It's still fairly rich. It's a 48.4 IVR. That's not nothing. I switched my particular stance today into the CLU5 contract, and now in both the short put spread and the short call spread and a short iron condor, effectively wrapped around the highs that we've seen recently. I'm not of the mindset that we're going to go back above them anytime soon. I also don't think we're clearing out the recent lows anytime soon, at least in the next 45 and 21 day out window type of situation. It's not, again, oil is not something that is super sexy to trade when it's not going through the throes of geopolitics or like COVID, right? How many times over the past few years, Jamal, on Futures Power Hour, have we said something like, what's the price of oil today? Let's bet on it being that tomorrow. And it works out for weeks and months and stretches of periods of time. If this is off the front burner, what did oil do after Liberation Day? Check down into a new range. What happened when we see the tariffs are getting lifted and we talk with China? We start moving up into a different part of the range. But oil, fundamentally, between like $64 and $75 a barrel, that is not problematic for the U.S. economy. It's only when you go above like $85 a barrel do both bonds and stocks start to get a little testy. And then once you're above 100, everyone's pissed off. But 65, 70, 75, as long as we don't get there too fast, the economy can handle this. And if anything, oil is correlated to demand for global goods. It has such a strong correlation with global GDP. So we don't want to see oil tank. The best case scenario from here on out is that oil stabilizes and slowly grinds higher, which we've just had an experience of a drop of more than 10% over the past 2 days. My search here tells me that oil on average produces a one-day bounce of 2.1%, produces a 1 week return of 4.8%, historically speaking. So a stabilization around these levels, like we flush this from the system. We should take advantage of the vol while we have it, but fading oil because of the geopolitical risk, that trade is dead. Put it in the pocket, it's over.
I'd have to look, man, but I don't know the last time we ever saw oil make two separate 10+% moves within a 2-month period for completely different reasons, and you get completely different reactions in the stock market. I don't know if that's really happened that I can think of off the top of my head. It's pretty crazy. And so it's clear, a person who wrote the article obviously is hunting for clicks. I'm not sure of the substance of the article, but as long as they detail the fact of what I just said, that's the most important part. Obviously, earlier in the year, we were like, oh my God, global demand is going down and, we're in a recessionary situation. And here it was more of the typical what we usually see oil move on, right? The geopolitical stuff type situation that we got the big moves recently, and obviously a different reaction from the stock market. So I know if you've caught them, they've been interesting trades, right? Like with oil and these moves, if you're one who likes to trade it for moves, if you just waited instead for the vol, I mean, that has totally worked out too. Like I said, I completely kind of butchered an oil futures trade, mostly because I was just worried about my upside in a condor that I had, a different condor than the one we initially had on, and that didn't quite work out. So I had to deal with the brunt of that yesterday. But fortunately, though, right? Like it ended up working out for me. Why? Because again, I'm long in NASDAQ call spreads. And so I was able to benefit, or at least from the market going up. So I am not interested in doing anything price-wise here as far as like picking direction in oil. I think, to Ilya's point, it's right back at sort of an average level now, I should say. It's probably starting a new average level, and I guess we'll have to wait and see. But it seems like it's going to start a new average level of around 64, 65. That's in the absence of all this discussion, if there's any, warmongering, et cetera. So that's kind of what oil is, but it does give you that opportunity to trade the vol. I mean, dude, the spike in vol recently was one of the biggest spikes we've seen in a while, and that's been the best thing to take advantage of. So, but again, it has been nice to at least kind of pay attention to oil for these different reasons, whether it was earlier for a recession and it was flashing recession signals, or now it's saying it's de-escalation in any tensions in the Middle East.
After that initial oil vol spike in 22, when we saw Russia invade Ukraine, it did subside a few weeks later, but oil vol, when we're looking at, you can do this on the platform. If you go to OVX:CGI, you can pull up the oil volatility from the COV crude oil ETF, USO. It hung in this 50 area for a little while, for several months. So you were playing basically chop in the market, but vol never really came out. I wonder, given today's action, not that we do technical analysis on volatility, but
we do not.
We did gap open lower in oil vol. We traded lower over the course of the session. Technically speaking, oil did close higher here today than where it opened at in the US hours. And it's coming against a pivot point in May. I got no technical analysis on volatility metrics, but maybe just playing for it to get pinned here. Vol has come off a great deal already. It could continue to subside like it did after Liberation Day, but Liberation Day lows are, 33 or so? And it took several weeks to get down there. This could be a slow burn, is my point. A ceasefire could be broken at any time. Last night, it looked like the ceasefire was not going to work because it was starting at 12 Eastern, 12 a.m. Eastern time, as President Trump was up tweeting, not just about the ceasefire, also about monetary policy, as one is wont to do at 1:15 in the morning. You see here that ultimately
makes perfect sense to me.
I mean, is he doing that or is somebody else doing it? Somebody else is doing that, right?
It's definitely him. It's absolutely him. I have a friend who in Trump's first term worked in the White House communications office, and she said that Trump tweets or dictates all of his tweets.
Nice.
To someone sitting next to him. So it's authentic.
Does he dictate the punctuation too, where the random things are capitalized and some things are in all caps?
Yes.
Amazing.
Yes, verbally, yeah. Anyway, OBX. So volatility's come off. It bounced. I would think that if we're going to be playing oil here, we have to just be cognizant of the fact that there's some, will the ceasefire hold? It's a good question.
I'll tell you
Is
what.
there anything that we could ask about this?
Ooh.
Maybe you should tweet the Ayatollah again.
One thing that's really interesting to me when you look at,
again,
and this is, of course, this is just a natural thing that happens with the exchanges, right? But when you look at what it costs to trade an MCL contract right now, that lets you know how high vol kind of is. It's like $1,600. This thing was like, you could get these for like $900 a couple months ago. So that part has really changed. It lets you know there's a lot of vol in there.
Jamal, we're going to find out some information here. We just tweeted at direct message the Ayatollah. Will the ceasefire with Israel hold? Please respond. Oh, nice. I will let everyone know if that. He hasn't responded to a single thing. I know he's been busy, but you got to. My wife always says you got to water your gardens with your friends, right? If you don't talk to your people, then your friendships wilt.
What kind of heartless person doesn't answer to the John Cusack say anything gif? I don't understand.
In fairness, the Ayatollah has been hidden in a bunker for a few days here, which is actually an interesting kind of overlay on all of this, because it seems like the IRGC, the military part of the establishment, has very quickly reasserted itself with new, young leadership, and seems to have edged out the clerics here for who currently runs Iran. And The Economist had a really nice article about this earlier today, talking about what has this strike actually done, and did we sort of remove the capacity for infighting with the old guard and the new that was actually keeping Iran more paralyzed, and have we now filled them with a terrible resolve? And there's certainly some evidence to that extent. So this is going to be interesting, but it's not going to be near term. It'll be quite a while before Iran can reconstitute, I would think, any kind of conventional capacity, even though reports now, as we're talking here, coming across from ones I'm seeing are from CNN, suggesting that in fact, the nuclear program was not utterly destroyed, as the president suggested yesterday, that initial intelligence reports suggest that actually no. But in any case, the concern here isn't right now. The concern here is what happens when a reconstituted Iran let's say, decides to use some of its extensive global network of non-standard actors to strike some sort of soft target. And how does that work going forward? So, of course, hopefully nothing like that happens, and we'll see. But in the near term, this doesn't seem like it's anything that the markets are going to care about right now. We're back to the deciding line for, do we have a growth scare or don't we, as far as the price action on crude. This is where we were stuck last time with that conversation.
I mean, this chapter is, if you're reading the intelligence that was leaked to the New York Times and CNN, according to the reporting here, which the White House has vehemently dismissed already, but entrances to the nuclear facilities were destroyed, but the buildings within the mountains underground were not. And so this may set back the Iranian nuclear problem or program for a few months right now. So perhaps we see this pop up again in the future, because they still have 400 kilograms of enriched uranium, which at 60%, you can't use it for civilian purposes like a nuclear reactor. You can use it for research, for isotopes, for x-rays, almost, a little bit more enrichment thereafter. But it's not a linear scale of enrichment. It actually takes a lot more to enrich it to 5%. Like once you get to the first 5%, you've done a lot of the work. Once you get to 20, you've done most of the work. The jump between 60% and 90% enrichment, from what I've read, is a lot less difficult than the first 5% of enrichment. Okay, but we said here on Overtime, Ilya, back with Dylan, back in February, because sometimes I tweet these things out just for the sake of there being a timestamp. Okay, one of the risks of the Ukraine war was that there'd be nuclear proliferation. And we've seen several examples of France and Germany and Poland all jumping into the fray. Iran is very much part of that. And if you're Iran right now and you're looking around the room and you go, what happened to Gaddafi? Oh yeah, he didn't have nuclear weapons. What happened to Kim Jong-un? Oh, he does have nukes. Okay, how about Saddam?
I was told the Libyans had the enriched uranium in Back to the Future, so.
They had an enriched uranium truck in Command and Conquer. That was like their special weapon. That's what I remember about Libya. I was always so confused as a child, like, why is Libya one of the bad countries?
I know, right? Okay, sorry, I don't want to make this go off the rails at the end. I was too.
Yeah. Okay, so it wasn't just me. I understood the U.S. and Korea and like Germany on one side, but like Libya, what did they do? Now we know. So there's an incentive structure right now in the world. Russia hasn't been rolled over because of its nukes. If Russia had attacked Ukraine without nuclear weapons, I think the U.S. would probably be a little bit more involved. And I don't think a lot of people would disagree with that assessment.
Clearly.
Right. I have seen a question pop up in the chat. How come we didn't do this with North Korea? And this wasn't today, this was yesterday. So one of my good friends growing up, until he was laid off recently from the Trump administration cuts, worked for one of the government's initiatives abroad in Africa, did a lot of foreign policy work in Kenya, various countries over the years. And he's become somewhat of a foreign policy expert. And so I like to sit down with him. We have these dinners with our wives now, and I ask him very extreme questions about foreign policy that he talks me up the cliff about. And so I remember talking with him and recently rehashed this conversation. What would happen if North Korea, we try to do this to North Korea? Seoul, South Korea, is within North Korea's artillery range, right? So if we try to dismantle North Korea's nuclear program at any point in time, it would incur massive civilian casualties. Whereas if you think about Iraq and Iran, the flight distance of missiles and bombs to, say, Israel, our closest ally in the region, is several minutes, and there's an opportunity to shoot down and deter those missiles to get people to shelter in place. So it's not one for one, but this story is not over. It's over for now. This chapter's closed, but the book is still being written. We'll learn more tomorrow, though, because Overtime is out of time. We'll see everyone on Wednesday, of course. Ilya's up next here with Macro Money. Tasty Live continues. So for Ilya Spivak and Jamal Chandler, thanks for tuning in. I've been Chris Vecchio. See you on the other side of a commercial break.
See you there, everybody. we've heard from Fed Chair Powell and we've heard from President Trump. Apparently, the U.S.-Israel-Iran war has been paused, and there is a ceasefire that everybody is begrudgingly going to accept for now. And apparently, we are in no hurry to cut interest rates in any way, shape, or form, at least until we get to September. So where are we going now? That's what we're going to tackle here on Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. We're going to unpack here a little bit, first of all, what the markets did, and then what the actual substance of these comments from the Fed chair looked like, because, of course, the geopolitical narrative is pretty much self-explanatory here when we look at today's cross-asset performance. Stocks put in a cheery day. S&P up 1.1%. NASDAQ even stronger, clearly 3.1% there. Bonds edge up a little bit, which is an interesting sort of a reflection of what is going on here, and perhaps a slightly incongruous one if geopolitics were the only thing at play. But of course, it weren't, and so we'll get to that in a moment. But otherwise, a fairly risk-on day. Euro up against the dollar. Yen a little bit higher, perhaps echoing what's going on in the bond market with those yields coming off. Crude oil, of course, the standout, down another 5.08%, having fallen over 8% yesterday. Gold in by almost 2%. Bitcoin showing signs of robust risk appetite, rising almost 2.6%. So a cheery mood generally in markets, and bonds and the yen kind of the standouts that seem to hearken a little bit to what's going on with monetary policy and these Fed comments. So what we had today was the first day of testimony, semi-annual testimony from Fed Chair Powell in the U.S. Congress. We had the House of Representatives here first. Senate is coming up tomorrow. The prepared remarks should be give or take the same. The Q&A portion obviously is going to be different, and we'll see if anything emerges there in that Q&A portion tomorrow that clashes in any way with what we saw today. But at this point, it seems like we're in for a familiar story. So once again, from the prepared remarks here first, Chair Powell saying once again that the Fed is very much in a wait-and-see sort of mode, because they expect that tariffs are going to push up inflation and weigh on economic activity, but they don't know exactly to what extent and how all of this will look, and so they're waiting to make a decision. And in the meantime, with an unemployment rate at 4.2%, which is very low by historical norms, and an inflation rate that's almost to target, and certainly much closer to target than not, at 2.4% on headline CPI most recently, the Fed really doesn't have an impetus to go quickly this way or that. It can afford to wait to see the impact from the tariffs materialize whichever way it's going to. And we see here that the expectation is that's likely to appear in June, July, and August. We, of course, haven't seen that inflation data yet. We'll have to wait and see. But clearly, the Fed themselves are in watch and wait mode, as Powell said here. And the concern, of course, is that if the Fed is right and the tariffs are inflationary, they want to keep them to a one-off increase and not something that drives up inflation expectations. Now, in the Q&A that followed, we see reiteration that the Fed does want to cut rates, and a majority of policymakers think that's what's going to happen. But they can't be cutting, and the reason that they're not cutting is forecasting both at the Fed and more generally is pointing to a significant increase in inflation this year. And that's, of course, that tariff impact. Now, Powell goes on to say that if not for that inflation forecast, they would have been cutting already. But as long as the economy is strong, they can pause here for a bit. And that, of course, then gives us what our reaction function looks like. For the Fed to start to move on rates, they want, or they'll need to see the economy weaken. And that, of course, means that from the market's perspective, the Fed is going to be later than usual to the rate cut party. That the Fed is going to either wait for the tariff impact to appear, then dissipate, and hopefully with no economic consequences as far as a lasting hit to growth, or that lasting hit to growth appears, the Fed can reason that the demand destruction there will countervail whatever one-off price increase from the tariffs, and they can focus wholeheartedly on that part of it and cut. But short of evidence this way or that, they're stuck. This, of course, comports with the FOMC forecasting update, the summary of economic projections that we got last week. We can see here downgrades to expectations for growth, a parallel upgrade to expectations for the unemployment rate. So again, a weaker economy and higher inflation, pretty much across the board over the 3 years of the forecast. And what the Fed seems to be saying on the rates front is that because the impact of the tariffs they now expect to see in June, July, and August, and it's somewhat delayed, not surprising, of course, with the 90-day pauses that President Trump announced to the sort of full breadth of the tariff regime in April, where the tariffs, the reciprocal rates, so-called, on most trading partners go up in early July and on China in mid-August, unless, of course, these pauses are extended. We have this kind of delayed reaction, and in any case, the rise in tariffs takes time to work its way through the economy, much like rate cuts do, or rate hikes for that matter. It takes a while for the economy to absorb a level change in prices for goods, for services, and for credit. So what we have is the Fed then saying, before we thought we'd go 50 basis points in cuts this year and again in 2026. That's what you see right here in the March set of numbers, and that mirrors what they said in December. Now we see we're going to take a year longer to get to that second 50 basis points. Now we don't get to 3.4 until 2027. And so the full scope for rate cuts over the 3-year period here, we can see from 3.1 to 3.4, has been cut by one increment, by one sort of standard size 25 basis point step. And that elongating of the timeline here seems to occur starting from next year. Now, what's interesting is, on some level, the Fed has a point. The most recent PMI data does, in fact, suggest that the economy flirted with standstill earlier in the year, but has now kind of stabilized, it would seem, clearly at a lower level than last year, but not dissimilar from where things idled in 2023. So, on some level, the economy is not screaming for immediate firefighting. This is, of course, the latest update to the S&P Global PMI data, the June update. And as ever, PMI data is expressed centered around the 50 line, where that's neither growth nor contraction. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So you see here, right at the beginning of the year with the onset of these tariffs and that growth scare that we saw from mid-February right until that crescendo in early April, there was a slowing down in U.S. growth to basically the 50 level across both services and manufacturing, and that, of course, took the overall economy the same direction. Now, obviously, there's been a slowdown versus the levels of growth that were on display in the second half of last year, but we're certainly off standstill now and back to basically where growth has averaged. It's been a slowdown, but not a catastrophic one, or not certainly anything that raises any eyebrows at face value. Moreover, just last week we saw that U.S. consumer confidence has meaningfully improved. The survey from the University of Michigan here showing that as inflation expectations linked to worries about the tariffs have eased, in June they've come down from 6.6 to 5.1%, so too consumer confidence has come off its critical lows going back 3 years to essentially the COVID bottoms and has started a meaningful recovery. So indeed, it does look like uncertainty is waning, the economy is holding up, and the Fed is not really getting yelled at by the economy, or so it seems. But the markets, interestingly, are of another view. And this is where there is a clear wrinkle in the narrative. At the beginning of the year, as we just saw that there was a growth scare and we had the bond market's inflation expectations head lower around the idea that what this growth scare would mean is a downturn in the economy and demand destruction. And this would mean that there is a pull down on prices as supply starts to overshoot waning demand. There's discounting, and invariably, as there is in an economic downturn, prices start to retrench, as it were. And what you have here then is a parallel decline in the S&P 500 here in the yellow, as well as break evens for the 5 and 10 year maturities, sort of the liquid the liquid ones that you can look at as indicators. And obviously, since early April, stocks have almost fully recovered these losses as sentiment has improved, but these inflation expectations are still pinned. And after this little scare here around the spike in oil prices linked to U.S., Iran, Israel conflagration, now that that oil price spike has basically fully unwound, we're again pinned inside this range established all the way back now almost 3 months ago. And so the bond market seems to be saying the Fed's confused, but the markets know which way it's time to jump. They're not concerned about sticky inflation from the tariffs. They're concerned about an economic growth downturn that keeps inflation low. And in fact, you can see that disparity in full relief, as it were, in what Fed funds futures are telling us about where the markets think the Fed is going next year. The 50 basis points they anticipated for this year, the markets have matched, and that largely seems intuitive because, of course, the calendar is limited. The markets don't expect any rate moves in July. We can see that here. We're sitting at the median rate here for this month and next. We start to tilt a little bit lower come September, and by October and December, we have our 2 cuts. Now, what's interesting is that since the Fed meeting last week, this curve has actually become more dovish, despite all of the counter narrative from the Fed, including Powell's comments just today. And we can see here that for 2026, the wedge has increasingly widened. And now the markets actually see 61 basis points in rate cuts there. That's at least 2 and about a 50-50 shot at a third. Whereas we just saw from the Fed's reckoning, they only see 1. And so we now have a significant disparity between what the market says the Fed needs to be prioritizing and where the economy is going, and what the Fed anticipates. And what makes this ever sharper of a contrast is that the markets do seem to have at least the momentum behind economic data on their side. This is the Economic Surprise Index from Citigroup, and what it measures is how economic data is performing relative to forecasts. That is, whether economic numbers are beating or undershooting forecasts, and it's scaled by the volatility of the currency market's response to the data. So when data is more impactful, it impacts the index more. It's also skewed toward recency. And so recent misses impact the data more as well. So what we have here is a fairly clear story going back to the middle of May, where U.S. economic data is increasingly underperforming relative to baseline forecasts. In other words, the economy is turning out results that are worse than what economists' models say they should be. Now, we can clearly see that this is the main sort of drag on averages for the G10, as well as for the global index right here, because if we see what's going on with emerging markets, they're holding up fairly well. Here's that zero line dividing what's going on with surprises upside versus downside. Above zero is surprising upside. Below zero is surprising downside. Obviously, it's immediately jumping out here that the U.S. is the only line on this chart that's under zero. But also, we can clearly see that emerging markets are actually showing relatively upbeat economic data relative to forecasts after an improvement from late April onward. Similar story for the Eurozone. There we've seen improvement since about late April, early May onward, and the slope is higher. And so this weakness in the G10 index, clearly not Europe. This weakness in the global index, clearly not emerging markets. And so the U.S. is the weak link here, seemingly. That, of course, is a troubling sort of setup when we consider, as we often do, that global growth is primarily powered by 3 big economies: the Eurozone, China, and the U.S. And if we take a look at the current setup for how those economies are doing, we are in a story very similar to where we were last year. Notice that these are composite PMI indexes again, and these are for these 3 key economies. Here's the one for the U.S. We can clearly see the pace of growth here is nice and strong in the second half of last year. In fact, the strongest we'd seen it since early 2022. Meanwhile, through the second half of last year, growth rates in China come down and slow to standstill. The Eurozone attempts a shallow rebound after recessionary conditions in the latter half of 2023. That fails, and we end up at standstill once again. Now, we don't have June PMI numbers for China yet, so these are the latest numbers from May, extrapolated here in the orange to make them stand out as forecasts. The latest numbers from the US and the Eurozone came out just this Monday, and we see the very same story here. China and Europe are idling. The US is now a lower growth single point of failure. And if this gives way, as the dynamics here seem to suggest,